So in 5 minutes time now, at the top of the hour, see the release of the US ISM manufacturing data for the month of April. Manufacturing PMI forecast 50 on the prior 50 spot 3, with a range of 51 spot 5 to 48 spot 5 expected.
Bigger NYCB November Yankee Charlie Bravo chat room
4
circulation
55 spot 8. The employment index forecast at 48 spot 2 on the prior 47 spot 4, and the new orders index forecast 51 on the prior 51 spot 4. With this data, we also see the job openings as well. This is for the month of March. They're forecast at 8.69 million on the prior 8.756 million, with a range of 8.836 million to 8.474 million as well. We also get construction spending month over month for the US, forecast at 0.3% on the prior minus 0.3%. 836 million data to 8.4.
Yep, sorry about that, folks. Sometimes we get a little bit of the echo chamber effect going. That's been fixed. Pretty big day in terms of all the data. Lots to parse, lots to digest. I think that makes it kind of an interesting day overall. It doesn't mean it's a day I want to aggressively trade. It's more a day where I want to sit down and parse a lot of this data that's coming out and the implications it may have, because over long time horizons, the macro does really matter. I know some folks try to debate that, but usually they're debating it by ignoring a lot of the prevalent trends and themes. And, you know, I think we need to be very cognizant of that stuff instead, especially the time frames at which this stuff can play out. It's not going to be 5 minutes. So in just about 2 minutes, we get JOLTS, we get ISM manufacturing PMI, and we're already seeing liquidity thinning out and the market dipping ahead of this. In terms of JOLTS, the consensus is 8.69 million. The previous was 8.756 million. And in terms of ISM manufacturing PMI, the consensus is 50. The prior was 50.3. For S&P manufacturing, the prior was 51.9, and the current was 50. It's flat, right? So you're still seeing prices rise, but you're not seeing expansion. That's a bit stagflationary. Just saying. All right, so just about a minute left till we see that data drop. It's going to be probably a bit of a market mover. You can see liquidity vanishing ahead of the data. This is why it's dangerous to trade events unless you know exactly what you're doing.
1 minute remaining now. I'll lead with the US ISM manufacturing PMI.
Data imminent.
Ten seconds. 49 spot 2, lower than forecast 50. Jolts job openings at 8.488 million, 8.488 million, lower than forecast 8.69 million. ISM manufacturing prices paid 60.9, higher than forecast 55.4.
Don't like that at
The
all.
new orders index at 49.1, lower than forecast 51. Employment index at 48.6, higher than forecast 48.2.
By 10-11.
To the markets now, to seeing some weakness in the S&P 500, a bit of strength in the dollar after a whipsaw as well. Also, US construction spending month over month at minus 0.2%, minus at 0.2%, lower than forecast 0.3%.
That is a stagflationary print right there, folks. That is not good. This adds to what I was talking about earlier, that prices are going up while activity is slowing down. I would be a little bit concerned about that. You know, it's not a good sign. The sector is going to have two choices, really. You're going to either be able to raise prices if you have pricing power, or you're going to have to deal with margin compression. On the other side, JOLTS came in weaker than expected.
So we have posted out the ISM manufacturing PMI April reports on the feed for anyone interested. Keynotes are that new orders and backlogs are contracting, production is growing, and employment is contracting. The supplier deliveries are faster, and raw materials inventories are contracting. Customers' inventories are too low. Prices are increasing. Exports contracting. Again, imports are growing as well. We've also posted out the JOLTS job openings full report, that being for the month of March. Treasuries hold their gains after the mixed ISM manufacturing data.
Let's see what that looks like here. Wow. There's the 10-year. Talk about a whipsaw on that data. So pop, drop, pop back up the point of control here. It is a mixed set of data. I would say that the drop is more about prices paid and the pop is more about JOLTS than anything else. Quits rate also dropped a bit here. So, you know, you are seeing a little bit of slowing in the labor market. Yeah, Coca-Cola does have pricing power. They also are a very efficient operation. So they can find other ways to cut costs. Let's go back to the S&P 500 and see where options are being traded. We have a pretty wide range of interest and prices here, to put it mildly. The top end of that range about 51.60, the bottom end of that range
iceberg alert.
49.69. So almost a
iceberg alert by 1,000.
Almost a 200 handle range right now between the hot call and the hot put from the SPX options visualizer that I created for Bookmap.
iceberg alert by 1,000.
Just noting some commentary from Wall Street Journal's Nick Timiraos on X. It says there were 1.3 vacancies for every unemployed worker in March, that being the lowest since August of 2021. notes that private sector job vacancy rates again fell to 5.3% in March, at the lowest level seen since January 2021.
So just a little bit of volatility here after these data points overall being taken in stride by the market today. And it is a relatively liquid market. We've got 53,000 contracts, order book depth on the S&P. That's around the range of decent liquidity. Let's take a look over at the NASDAQ as well. Looking a bit choppier, really, than the S&P, which is not too unusual, but I'd say that, I'd be a little more concerned about how the NASDAQ fares on a day like today than the S&P, just given that it tends to be a bit more rate sensitive. And it does have exposure to some stocks that are maybe going to be a little bit more temperamental depending on what the Fed does, right? So that could be your bigger mover. It's obviously a higher beta index because of its constituency, but
yes, iceberg alert by 1009.
Getting a little bit of seller absorption attempted there by buyers. We heard that with the call out on the iceberg alert, but overall still just pretty much flat and getting rejected by VWAP here on ES. Let's take a look at some of the unusual options flows that are happening. And I like to look at the amount of unusual sweeps in puts versus calls in individual stocks, ETFs, and at the index level. Right now, it's pretty much even. So there's not a lot of bullishness or bearishness in excess at the single share and ETF level. At the index level, there's about 18% more demand for puts than calls in SPX. So with all this data, I still don't necessarily think that the Fed has any cover to even talk about cutting. I expect them to be much, much more reserved about that outlook today. I think that will be something that's expressed both in the statement and by Powell during the press conference. So I think that we've gotten enough data to say that prices are still largely on the rise, and employment is still pretty strong. I mean, 1.3 jobs offered for every one person seeking work. It might be the lowest level since like Aug 21, but it's still a tight labor market. On the other side, you've got prices paid surging in manufacturing. That's not what I'd want to see. So the next data points that we'll be getting will be EIA crude oil stocks around 10:30 a.m. And then we have a 17-week bill auction that I suspect won't necessarily be much of a market mover. And then, of course, we've got the Fed interest rate decision at 2 p.m. and the press conference at 2:30 p.m. We are also in an earnings environment where misses are the least forgiving that they've been in quite a long time. The average miss receives about a 4.5% markdown for the stock. So it is a time to be cautious. You know, these companies that aren't making expectations, we can see what's happened with companies like Starbucks today, for example. The stock is down 15.52%. That's no joke. AMD down 6.9%. Former market darling Super Micro down 15.8%. Let's take a look around some of these other areas of the market. And folks, if you have anything you want me to pop on screen, any charts you want to look at, do let me know. Thoughts on Meta? Yeah, let's take a look at Meta. Love it. So Meta here is at a kind of key point. It has a sort of trend line that it was trying to defend that's a little bit more generous than the one I've drawn here. That I shared on my Twitter feed. But basically, we're in this sort of zone. We're building some volume here. I'm more inclined to think that we move lower to about 403.14 because I do think we're in a correction in the broader markets, and that could be set to continue. So I'd be more inclined to look at rebidding this thing down there. I'm not very interested in where it is right now. But if it does start to slip lower, like below, I'm going to say about 427 or so, I think that it pretty much becomes almost certain that we get back down to this lower level around 403.14. At that point, we filled in the gap. The structure of the chart starts to look a little bit healthier. But the other thing we need to be concerned about is looking at this.
Yes, iceberg alert. By 1001.
If we're looking at this via Ichimoku, we're below the cloud. So that means the stock is no longer in an uptrend. So if it was to rebid around 403.14, assuming we kind of get a nice bounce there, it would be a very small starter position for me. Because, you know, we're still not necessarily out of the woods in this thing. I think the Meta conference call was an absolute disaster. Mark Zuckerberg spent most of his time basically talking about how much money they're going to spend on AI and how they don't have a clear path as to how that's going to be monetized and how it even ties into their spend in the metaverse. I think that brought a lot of post-traumatic stress back to investors who, you know, gave that conference call a big thumbs down. And I think that that's an issue here is that, you know, yeah, Zuck is not a terrible business person. He knows how to make money. He's got this brilliant advertising engine at Facebook and Instagram, right? And that's doing well. But what he doesn't seem to be very adept at is innovating. So he's often copying and pasting other business models. You know, there's examples like Facebook trying to create a phone, Facebook trying to create a hardware conferencing device.
Yes, iceberg alert. By 1001.
There's Threads, right? There's their imitation of TikTok on Instagram. All those things didn't go so well. And then there was the metaverse, which was basically copy pasted right out of Second Life from 20 years ago, where the capital was Metaverse City. So the question is AI going to be different? Is this going to be the initiative that actually works? I don't know, but what I do know is it's been a show me story for over a year, and we don't have much to show for it more than billions of dollars committed to additional spending.
By 1,000.
And this was supposed to be the year of efficiency for the company. So I'm a little concerned about the story here. I think it's breaking down a little bit at Meta. I think that this is a company that still needs to kind of demonstrate that the engine of growth is intact, that they have a plan to kind of pivot to the future, and that they can monetize AI. So from an investment standpoint, I don't really have any interest because I don't have much confidence in management. Their vision seems incomplete here. So hopefully that helps from both a short-term technical and long-term fundamental outlook on Meta.
Yes, iceberg alert. By 1008.
So I've been asked to look at New York Community Bank here. It looks like it's getting a bit of a pop. And we saw it kind of base around this range. We'll probably have to just draw one more crayon line down here just to kind of indicate that this is also an area of interest for buyers. But I would say that this is a decent little move. Perhaps it gets pulled back up to the point of control here around 383. I don't really have much interest trading this thing just because it's, it's below $5, so it consumes all buying power. The options in it aren't incredibly liquid.
Looking now to the fear and greed index, 43 out of 100, which indicates fear, while the crypto fear and greed index is at 54 out of 100, indicating it neutral. So keeping an eye on the VIX as well, it's currently up 2.5% at around 16.04.
So I'd be looking at this thing saying, yeah, I could get back to the top of this range.
Iceberg alert. 383. By 1008.
383 is about where I'd be looking to take everything off on this if I was in it, or at the very least
China vows to roll out policies to boost economic recovery.
Oh, good. Been hearing about that since November of 2022? Maybe this time will be different.
In 10 minutes time at 10:30 a.m. Eastern, we get our weekly EIA inventories. Crude, a forecast draw of 2.5 million on the prior draw of 6.368 million, with an expected range of a build of 1.5 million to a draw of 4.572 million. Gasoline forecast draw of 1.02 million on the prior draw of 0.634 million. Distillate, a forecast of a build of 1 million on the prior build of 1.614 million. Cushing, prior draw of 0.659 million.
And seeing S&P get resistance here at VWAP so far, there is a decent amount of resting liquidity overhead, and we continue to see a fair amount of interest in lower prices in the most active put contract here. Obviously, the hot call also has interest in much higher prices, but it is not nearly as actively traded so far. Thoughts on Amazon's earnings. So I did share some yesterday. I think that they gave decent earnings, but the guide was a bit soft. So, we're getting a decent pop in the stock today, but it's still, to me, like, I was really looking for them to knock it out of the park. I didn't really get that. So what I do like about the stock overall is it head faked below the 20 and the 50. Now it's moved above both. It actually bounced right off the 50 and it's trading right against the 20. So as long as it's able to hold that 20-day moving average, I think Amazon's in good shape. AWS continues to fire on all cylinders pretty well overall. But I do think that e-commerce is going to see some headwinds because consumers, the bottom two quartiles, are still pretty cash strapped. And that's a key part of Amazon's customer base. So cost cutting has served them well. Increasing costs to sellers and otherwise has served them well, making it more difficult to return items. And even though they said prime deliveries are going faster, I've seen, quite frankly, the opposite. All that serves them well, helps them to sort of save money across the board. But at the end of the day, I think that this is a company that could deal with some headwinds in their e-commerce unit. I'm not as concerned about AWS as long as the sort of AI-driven cloud consumption is continuing.
In 5 minutes' time at 10:30 a.m. Eastern, we get our weekly EIA inventories. Crude, a forecast draw of 2.5 million on the prior draw of 6.368 million, with an expected range of a build of 1.5 million to a draw of 4.572 million. Gasoline, forecast draw of 1.02 million on the prior draw of 0.634 million. Distillate, a forecast build of 1 million on the prior build of 1.614 million. Crude, on the prior draw of 0.659 million.
OPEC crude output fell 50,000 barrels per day to 26.81 million barrels per day in April, according to a survey.
1 minute remaining. I'll be leading with EIA crude oil inventories. Ten seconds. A build of 7.265 million, a build of 7.265 million. That's higher than the forecast draw of 2.5 million. Gasoline, a build of 0.344 million, a build of 0.344 million. That's higher than the expected draw of minus 1.02 million. Distillate, a draw of 0.732 million, a draw of 0.732 million. That's lower than the expected build of 1 million. Crude Cushing, a build of 1.089 million, a build of 1.089 million. US oil futures extend losses down 1.2% after the US EIA storage report. We have posted out the weekly EIA inventories report to the feed for all those interested.
Let's see what kind of reaction we're getting, if any at all, to that data. Not a great reaction. So crude getting sold down as inventories come in much higher than expected. The forecast was for negative 2.5 million. The actual is a build of 7.265
The Department of
million.
Energy says the US SPR is up 0.594 million barrels at 366.271 million barrels.
So yeah, overall, that's not being well received by crude oil here. And we are getting kind of back into the potential rebid zone. Let's see if we are able to hold 80.56. Again, EIA crude oil inventories came in at 7.265 million versus a forecast for a draw of 2.5 million. We had a build instead. Prior reading was negative 6.368 million. Let's go back to the S&P 500 futures here, just sort of engaging in Paint Simulator, or Paint Drying Simulator 2024 for much of this morning's trade, just sort of been a sideways chop overall. Let's go back to oil here, still digesting that data. And once again, you see liquidity just disappears before, the number is set to come out. And then as soon as it does, or even in this case, maybe moments before, maybe someone knew something. Maybe it came out a little early. Well, on my feed, it came out at 10:30 on the dot. But here, you could see around 55, 5 seconds before, you started to see a little bit of selling pressure, even 1 second before you kind of started to see this big gap down move before the data was actually released. So, the government likes to tell us it's all firewalled and no one gets the stuff in advance, but I continue to see this type of trading behavior and all kinds of data releases that suggests otherwise. Let's take a look at rates here. We got the 10-year on screen, not really doing anything exciting here today. We had that pop, drop,
US
and
crude
repop.
stocks rose last week to the highest since June 2023, according to the EIA.
We got the euro on screen. This is sort of the anti-dollar. It's about 70% of the other side of the US dollar index. Looking modestly constructive this morning, pretty much flat ahead of the Fed. Amazon post earnings. Let's zoom this one back a bit, because I know I had a little bit of a sell early. So you had that dump into the open. You recovered. You got up to this large area of resting liquidity around 182. They were able to take that out, but that was a lot of absorption by sellers, and so there wasn't really enough oomph left to keep that demand going. So we saw prices kind of roll back down. Checking back in on crude, it seems to be settling after that move lower, back in the bid zone.
stocks then go up nearly 18% on an annualized basis at a low rate, at a high rate, up a little bit less at a 14% high. Now, this is interesting because this is not, again, the dynamic we're in right now, but up 8.4% the back of midday, and that signaled, I believe, that the economy was slowing so much that stocks went with the economy, that 6-month crystal ball factor of the S&P 500. I think that this is not as much the dynamic today, but really super interesting. And then let's put the VIX into it, because going into today's Fed decision, we have the VIX at a 16 handle. That is historically low. That's the highest level that we've seen for the VIX during any of the recent Fed meetings over the last year. Since last June, you can see that on an equal weighted or a comparative basis, and it's been lower. So investors are a little bit nervous about what the Fed is going to say today. So that's some stars and some here today. We're very excited about it. Thank you so much. Now, coming up, we're going to get to the Fed. Rates for AI chips. We'll speak to my Taylor, who's Chipmore author and top university professor of international history, about the winners and the losers. This is Bloomberg.
Sometimes about 5-10 kilometers from and
Well, we have a little reprieve from the constant flow of economic data and various other chatter. So I'm going to take this as an opportunity to get up and make a new batch of tea, but I will be returning. So stay tuned, and the stream will stay live. We'll have the chatter commentary from our Squawk Box on here as well. So, give me like 5 minutes or so and I'll be back on here. I don't suspect anything too incredible will happen while I'm gone. All right, folks, I'm back. Hope you all are having a good trading day out there if you are so adventurous to be trading in this environment. We do see a large amount of resting liquidity building overhead here, so it's something to keep an eye on, especially if we get reflected lower from it. Oopsie. Just doing a little check on the settings here. Don't mind me. And we do see S&P futures pushing into this large area of resting liquidity overhead. Let's see if we get rejected there or if we're able to push through. If we do get rejected there, it kind of puts us back into a state of consolidation where we'll probably get reflected lower to the VWAP and point of control and potentially lower than that. But if we're able to push above there, it is showing us that buyers have a reasonable amount of demand. So it again goes back to that idea of the market is basically just a constant two-way or even three-way auction. Seeing industrials like DuPont and 3M hitting 52-week highs, one of the key themes that we've been talking about for pretty much all of 2024 at MacroVisor has been long industrials, as well as long materials, long metals and mining, long energy, long aerospace and defense. And overall, those trades have served us quite well. And I think that dips are to be bought in a lot of these areas. And we're just chewing through that liquidity now here. Just overhead, we're seeing not high conviction buying, but buying starting to push into that large resting off area. Now there's some conviction growing. We're starting to see some buy side stops getting pushed out here as well as volume grows. Tesla short still working, trading down to 180.12. This is one we identified at 186.37. So over $6 ago, trade continues to move in our favor, and I really don't have any desire to get out of this thing unless it gets down to about 157.45. And, you know, it can be traded with shares, or the other idea was a vertical put spread for June with buying the 157 and selling the 156. So that trade's in motion. So far, so good. It could be a bit bumpy because Tesla is a stock that people get real emotional about, and typically, you know, it gets whipsawed around in both directions. But I think it's still in a structural downtrend, and the path of least resistance remains lower for now. Let's take a look at what's going on out there in the world of options. Still pretty balanced overall in the ETF and single stock options. XLU sweep 67.50 for this Friday, about 103,000 paid for that, getting bullish of the utilities, an area we've been bullish on for some time. It's been rewarding. It's been a great defensive place to allocate, but there's also a longer term macro trend of more and more power usage that is driving demand for utilities. So on everyone's mind, in less than 3 hours, of course, we get the Fed interest rate decision, their policy announcement, and then a half hour later, we, of course, have the press conference, which I think is going to be even more important. So overall, what I'm watching here is for a more hawkish Powell. I think that Powell made a calculated error in November, leaning into mission accomplished being the baseline. And now I think it's kind of probably time for him to take the other side of that. As we heard from him recently, he's no longer dovish, right? He's kind of taken to go back to that hawkish tilt that he's shown. And I think that matters because, you know, a lot of this relief that we saw in financial conditions, that we saw in equity markets and in rates was predicated on the idea that A, inflation is coming down, and this great disinflation that we experienced for much of 2023 was durable, and B, as a result, the Fed was going to cut up to 7 times this year, as was priced in late December of 2023. Now the market's struggling to price in even a single cut, looking at December for the probability of that potentially happening. That's maybe a little bit of a concern, because if you contextualize what all drove this, disinflation and rate cuts, and now we're getting inflation and the Fed talking about we're not sure if we're going to cut, we may even hike, it changes the variables quite a bit. So I don't think we're in the same environment where things are as forgiving, where, you know, up and away is sort of the trajectory of least resistance for equities. I think we're in a much more of a stock pickers environment, much more of an industry sector pickers environment, also a geographic region, you know, pickers environment for allocating outside of the United States. And I think we'll be in that environment for some time. I would also want to remind people that are out there saying, well, what about 2023? Didn't that show us the Fed doesn't matter? No, but it did show us that fiscal dominance could overpower the Fed. So I've heard a lot of tinfoil theories like, oh, you know, in 2023, the Fed did stealth QE and that's what drove the markets. And, you know, they're lying to us. Well, no, they're not. Like, let's be realistic about this. It's not that they're lying to us. It's that, A, the Bank Term Funding Program temporarily increased the size of the balance sheet as they absorbed some risk, but that wasn't necessarily QE. That was more sterilization of some level of systematic risk. What added to bank reserves, what added liquidity to financial markets, what stimulated the economy primarily through demand was late cycle fiscal stimulus in the later part of the year. And in the earlier part of the year, it was the cessation of debt issuance by the Treasury. And it's no coincidence that lasted like a whole 6 months. You know, it was this political kabuki theater. Oh, we can't agree on a budget. Oh, we're going to have a government shutdown, yada, yada, yada. You remember all that nonsense, the saber rattling. But everyone in politics knows that if you cease issuing debt during a time where the Fed is hiking rates and when they're doing QT, then you can sterilize a lot of that impact, right? Similarly, if you do a lot of late cycle stimulus, like the CHIPS and Science Act and the Inflation Reduction Act, during a time where the Fed is trying to keep rates higher for longer, it will also neutralize a lot of that impact. So on the other side of this, I get a lot of people that come onto my feed and reply to every time I question why should the Fed cut here with a chart of U.S. interest payment outlays. You know, that it's going to go up to 1.7 trillion year over year by next April. That's fine. I get it. People are concerned about the amount of deficit spend on interest. But the problem is that if last year proved to us that the government can fight the Fed and the market can fight the Fed and win when they're hiking, then what makes us think that's not true when they're cutting? I really think that's something we need to think about here. So if and when they do cut, which keeps getting pushed off later and later into the future, I don't know that it's necessarily going to have the impact that people think, because if it happens amid an environment of elevated inflation and a structural secular bear market in bonds, their cuts may not move the short end of the yield curve as much as they ordinarily would. So my base case is we do steepen out of inversion, but we steepen out of inversion with the long end rising more because there's no term premium. And if the Fed's only set to cut maybe once this year, then there's not a lot of reasons for the short end to fall. So without some kind of economic or financial calamity, rates can keep marching higher on the long end. So, you know, I just think it's important to have a bit more of a nuanced conversation about the Fed and their impact, because they do not control the rates market. They influence it to varying degrees, depending on other variables at play. And so, you know, there's been a lot of sort of maybe unwarranted significance given to the Fed up to last year. Last year, a lot of people started to become almost too skeptical of the Fed, believing they have no power at all. I would push back on that quite a bit as well. They do. They influence markets. They have the power to influence markets. They just are not the market. And when there are overwhelming forces moving the other way, it can more than offset the Fed. Right? So I would just caution that even if we do get a cut or two this year, it doesn't necessarily mean that rates are going to come down, or that bonds are a screaming buy opportunity, or that past is prologue for what's going to happen to equities or rates. I think that, you know, there's still opportunities in this market. I've been kind of screaming from the hilltops this whole year about the old economy trade. And last year I started talking about, you know, this idea of a theme of from abundance to scarcity. You know, some of that's artificial, some of it's natural, but we are seeing a little bit more scarcity in a number of areas: energy, key base metals, overall labor, availability of water, potable water, arable soil for farming, energy. You know, not just like the ability to generate it, but the ability to transmit it. These are all areas that we're going to have to address. And the components of the economy that benefit from that are the old economy stocks. So that's why I've been bullish on those sectors. And, you know, if you hear me talk about it, you're probably going to think, oh, he's bearish of everything because he's saying inflation's going to come back and the Fed's not going to cut. No, I'm sorry, but that's not the case. The reality is actually a lot more nuanced. And quite frankly, people's views on the market are much more of a large series of different gray areas between just binary bullish and bearish, right? Someone may speak bearishly about the index, but still be bullish of sub-industries and sectors and other regions and asset classes, for one. Secondly, you know, I'd like to remind folks that we are in a world that is net long. Even the most aggressive bearish funds out there are net long, most, if not all of the time. You know, and for me, when I get bearish on something, I like to marry it against a bullish trade. I like to do a lot of pair trading. So I like to identify relative weakness in an area I want to fade and relative strength in an area I want to buy, and then match those against each other in a pair trade, because that for me has worked out pretty well. So we do see a little bit of a pull happening in S&P futures here. We also see the midpoint coming on screen as the balance between the two most transacted puts and calls in SPX are within about 20%. And that midpoint is telling us that from an options auction perspective, it's a market that's in relative balance. The hot put, however, lays much, much lower here. That interest level about 51.31 in ES, if we translate that from SPX levels. That also tells us something else. There's a lot of interest in hedging SPX 5000 because that's what that level correlates with. And folks, if you're enjoying the live stream, please retweet it out to your friends, share it. It's at the top of my feed here, and throw it a like, throw a reply in. If you've got any questions or feedback, feel free to share. We've got links for the YouTube and Twitter at the top of my feed. And the more folks that are able to tune in, the better, because I do like to try to help as many people as I can. I know this is not the easiest market environment. A lot of people looked like geniuses last year because it was easier to be bullish. And even for all the wrong reasons, you could still be right in the market at the index level. I don't think it's going to be like that this year. I see a lot of the same folks slipping a lot because they're missing on some of the underlying moving pieces that are happening here. And of course, also there's just this emphasis of let's just only buy the Mag 7. Let's ignore the rest of the market. I think it behooves us to actually look at where the relative strength is being shown. And, you know, maybe you could say there's still a Fantastic Four, not so much the Magnificent Seven, but the more encouraging relative strength is, again, happening in the older economy parts of the market. And if the Fed is tempted to cut this year even at all, I think that provokes more upside potential for inflation, and that benefits those same places. It's not so good for growth. It's not so good for tech. It's not so good for long duration debt. It's generally quite good for old economy stocks where they have pricing power. So context is key. Now, if I was a voting member at the Fed and we were making our decision today, I'd be looking at all this data that keeps telling us that prices paid are on the rise, whether it's ISM, manufacturing or services, whether it's CPI or PPI or PCE, whether it's the businesses that continue to plan to raise prices where they can from the NFIB survey, and a number of different areas, whether it's commodities being bid up over 20% on average from their lows in 2024. All of this tells me there's still pricing pressure. And that pricing pressure is resolved in one of two ways. It's either resolved by companies raising prices and passing this on to others, or it's resolved by margin compression. So in this environment, you want to be getting involved with the companies that are able to realize pricing power, right? Because the ones that are going to see margin compression, that's not good for their earnings. They're going to be earning
for
less.
CME sell at 50.51 crossed.
Pretty decent iceberg sell there, about 922 contracts. An iceberg sell is just a passive large institutional order that basically they hide their total size until the whole order's been executed. Then you can kind of see the footprint, right? So to explain what an iceberg is, because I see a lot of varying definitions of icebergs, there's only one real actual iceberg. It is an order type that you place when you have such size that you don't want to scare the other party away, right? So if you're on the offer side and you have 10,000 shares of something to sell, you might show that as just 500 on offer. And you might run through that 500 offer 20 times to complete your iceberg. You do that because you'll realize if you've traded stocks and watched the order book or futures or otherwise, if you go in with too much size, it scares the other side away a bit, right? And then you don't get the kind of fill you want. So the advantage of icebergs is if you're trading a larger book and you need to get out of something, you can kind of play a little bit of poker with it. You kind of get to hide your total size,
yes,
right?
iceberg alert. Sell 1002.
That's what an actual iceberg is. It's concealing the larger order size until the order is complete. The advantage is that sort of subterfuge versus the counterparty. The disadvantage is every time your order gets hit, like that first 500 lot gets absorbed, now you're at the back of the line unless you are the prime broker or you have a really good deal with them. Traditionally you're put at the back of the line, which means the other orders that were ahead of you then get to execute. So for us retail folks, we need to be considerate that icebergs can be helpful if we're really in a position that's not super liquid, where if we show our size, we could scare the other counterparty away. That's where an iceberg becomes appropriate. Now, all the other definitions of icebergs are just gobbledygook. They're just extrapolations looking at volume profile or footprints or otherwise, and in making inferences, assuming that's what you saw. But if you don't actually have the order flow to qualify it as an iceberg, then you're just guessing and you don't know, and it's not really an iceberg. That's one of the reasons I like Bookmap, because the rhythmic data actually shows you real icebergs, not imaginary ones. Seeing a little bit of a pull here on S&P. We do see a little bit more liquidity building above here, just around 50.77, 75 or 50.78. But that most active put strike becoming a little bit more magnetic here as we get pulled below the point of control in VWAP. So the Advanced SPX Options Visualizer add-on showing us that there is continued interest in prices lower from here, and that would take us down to cash SPX 5000 if we get all the way down to that hot put. Let's take a look at oil and see how it's digesting things here. Wow, nasty move in oil. So we're going to have to go ahead and break out the longer term chart here. Oof. That is the technical term for this. That is a oof. So oil is now slipping into the cloud. It is below the trend line. It is below the rebid area. So we have an opportunity here for this to either be a head fake look below and we get right back up into this zone. It actually ends up being bullish because a lot of shorts get stopped out and we resume the trend. Or if it closes here like this, just below that trend line in the cloud, we've just neutralized our uptrend and we're now in a phase of consolidation. So this is a pretty key moment here for energy to see what we're going to be doing over the short term. And I would be just a little bit concerned about this potentially turning into a head and shoulders pattern as we seem to be confirming that right shoulder. So far, you know, it's still too early to say because these things can get reversed. We've seen this happen in prior look belows. Like here's a look below that was rebid, but I would still be looking at this with a little bit of concern. Crude oil front month contract down 2.69% here after a much larger than expected inventory build. That's an interesting thought there, Al, that it does in a longer time frame have a more constructive look. So let's take a look here at a favorite for a long time that seems to be now in a pretty decisive downtrend, and that is SMCI, right? This is another one that has that sort of head and shoulders-y look that's confirming. But the other thing is earnings didn't really inspire. I know there's a lot of folks wanting to rebid just around here. And look, there's a technical reason why, right? You've got an area that is a bit of a demand zone here. It also correlates where we've seen buyers sort of try to take control in the past. I would just suggest that the big problem that I have with this stock is I don't see its durable competitive advantage. And maybe I'm just lacking vision, but I don't see anything that SMCI does that would not be able to be done by Dell or HP Enterprise or other hardware integrators at a much greater scale with a much lower margin because of that scale. And that could pressure SMCI's margins and their revenue growth with increasing competition. That is to say, I just don't see a durable moat for this company. You know, and look, I understand the excitement, and for a while it was a fast mover and it was showing some strong growth, but this is an industry that typically has very low margins. computer hardware integration and all that typically has very, very low margins. So it's not an industry where I'd necessarily want to be getting super duper long, especially after a stock has run this much and a lot of that growth was pulled forward. A lot of those returns were pulled forward based on the notion that, you know, the future is going to be even better than the present. But the reality may be a little bit different on that one. And it makes you kind of want to look at stocks like Dell, which while they have a similar look, they haven't necessarily seen that same pullback. So, you know, I would be a little concerned about this one as well. I think, you know, we have this gap here that we could potentially fill. And we've seen that as something the market tends to like to do. So if this stock does slip below 106.21, 94.19 does come on screen pretty quickly. And that would also be putting us into that sort of, we're getting into the cloud or potentially a downtrend type of scenario. So I'm still looking at the whole hardware integrator spaces. You know, Jeff Bezos likes to say, your margin is my opportunity. Well, a lot of these guys are going to be eating their margins to be more competitive against others in the space. And I think SMCI is, investors are starting to realize that, but I don't think that's going to be a stranger to the other companies in the space as well. I think competition will heat up in the GPU compute area, and in other areas like the sale of workstations, that's set to continue slowing. Yeah, Dell is big in the data centers for sure. I know a number of folks in the industry that are buying Dell servers. But the concern is, you know, the data center space is becoming increasingly competitive, and so margin erosion is becoming a theme. So they may be able to grow revenue at the cost of profit. And I think that's a theme that we're going to see more and more of. It's going to become more and more competitive. I've been asked, is a decline in oil a precursor to recession? A more meaningful decline? Sure. Typically, what you see is a shock in oil prices higher before a recession, and then a big decline led by a drop in demand. It's too early to make that out of one data point. We'll have to see where things go from here. Is power consumption an issue at data centers? That is an excellent question. Yes, it is. So in the United States, power demand is set to about double over the next decade. And within that time period, it's very, very likely that we're going to have to build out a lot more generative and transmissive capacity across the United States. And that's because of data center growth. That is because of what we're seeing in manufacturing coming back onshore. That is because we have EVs being plugged in and charging. And all that adds to an inordinate amount of demand that our current grid cannot take. So there's a big expansion in regions where there's large amounts of manufacturing capacity, where there's large amounts of data center growth, and there's just key areas, right? Data centers don't necessarily get built in a sort of evenly distributed pattern. It's more about where's the connectivity? Where can we take advantage of the availability of bandwidth and power? That intersectionality helps to determine the geography where it's attractive to build data centers, and then composite onto that, you know, cost of property versus cost of opportunity. And so you can kind of get a better idea of where data centers are going to be built. Like a lot of them are built on in the East Coast, in the sort of East Coast Silicon Valley corridor of Ashburn, Virginia. A lot of them built in California. We're seeing more being built in you know, in Utah and other parts of the country like that, where it's cheaper to do so and connectivity is improved. Of course, you still have a lot of data centers in New York as well. And you have globalization of data centers. You've got data centers being built all over the world. Part of it has to do with AI, but another big part of it is that we're just relying more and more on compute. We're generating more and more information, and then we're wanting to get a better idea of what value does that information hold for us. And that's where machine learning can start to become valuable. It's sort of a component of AI, and it's one that's shown a lot of value, sort of machine learning driven analytics. Rather than having, you know, teams of people or more primitive code combing through your data, you can use machine learning to derive, you know, analytics that might help you discern trends or might help you to discern insights that you would not otherwise have. So there's all kinds of reasons for that spend to continue. And I do think that power consumption is something we should be concerned about because it provides bullish catalysts, right? It's good for utilities. If they're going to be building out increasing generation and transmission capacity over time, they're going to realize larger revenue and perhaps margin expansion. It's good for the price of copper because a lot of that transmission is going to happen over copper. Aluminum is a secondary. It's used for some utility as well. It's also good for copper miners, because during that period of time, you're going to have to be pulling more copper out of the earth. You're going to have to be finding more copper that you can eventually pull out of the earth. And there's a long lead time to that. And right now, copper is in a structural deficit, which is one of the reasons it's sort of broken out of this long-term consolidation. So I'd say that, yeah, the increasing data center growth, it definitely puts pressure on power demand, but I think it's a bullish catalyst for a number of different opportunities in other industries that kind of feed into that. So hopefully that's helpful. You're very welcome. Great question. This is something that, I've been talking about for a little bit because I see it as an area of opportunity. I think it's part of this, old economy stock kind of catalyst that a lot of folks are overlooking. Also, a lot of folks are overlooking the potential of inflation coming back. There's a lot of complacency about the potential that inflation could come back. And I think it already is showing signs of coming back in the United States. Now, it just tells us that there are different parts of the market to invest in that environment. It's not all bearishness. It's not all doom and gloom. In fact, I think folks that infer thinking inflation coming back is doom and gloom are just not full cycle investors and don't necessarily appreciate the nuance necessary to survive in different macro regimes. That would be my 2 cents. And again, 2023 was the market on easy mode at the index level. 2024 is not the same. And a lot of folks who were, riding easy mode and loving it may be due for a bit of a wake-up call this year, because things are shifting into a different regime where stocks that many are not as familiar with are probably set to take the lead. So far, they already are. Energy, industrials, metals and mining, materials, aerospace and defense have all been outperforming the S&P. And that shows you there's a bit of a rotation into those sectors and industries as well. Let's take a look at the NASDAQ, see how it's faring compared to the S&P. Getting a bit of a pop here. It seems like this point of control level, though, has been resistance that comes in at just about 17,458. Let's see what happens this time if it meets a different fate here. Would you be looking at companies that expand our electrical grid? Yes, I absolutely would. I think that's part of the construction demand and industrial demand. That can be an area of opportunity because that's an area of growth. I mean, electrical demand is expected to rise in the U.S. by about 100% over the next decade. So that's like basically a clean double. So every company that's involved with that's well run, has a clean balance sheet, strong free cash flow, there are going to be opportunities there because they're likely to see improvements in both their top and bottom line. I'd also be looking at, some of the better run utilities, some of the better run copper miners, some of the companies that are able to engage in natural gas production and are doing reasonably well at it. Diamondback has largely shrugged off the declining price of natural gas, or overall well-run company. So, there's a bunch of different areas of opportunity, but you got to believe a lot of that data center power demand is going to come from natural gas-fired plants. I am not so sure about nuclear yet. We still haven't resolved the waste disposal issue. Like, I'm bullish on nuclear overall, but what I need to see is some concrete agreement about how we're going to deal with nuclear waste so that we can actually scale up that form of power generation as needed. We did get news not too long ago that Amazon is actually building a new data center basically right on top of a nuclear plant, so they always have access to that source of power. So we already know there's that interest.
generation. These are fastest growing minorities. The other ways right now. So improvement of the product has been broad based. Is that actually going to for? Or else we're just getting the we see.
And we are seeing now NASDAQ actually trying to build above that point of control. So are we going to make our way back up to VWAP here? That would be the next level to logically challenge here. Still just sort of playing market ping pong overall. S&P showing a similar look, moving above the point of control and VWAP here. And it sort of got this magnetic pull around the second most active put strike, which coincidentally or not, lines right up with the point of control and VWAP as well. That's one of those convergence levels that tells us this is a more important area to watch.
So they're not necessarily searching for a specific brand or a specific item or maybe decisions already made. They're coming with much more almost like cool outfits for some rain. What to wear to go to the show. And there was a rating movements for average items too because the user has a clear intent. They have to decide what to buy. And again, we're seeing that broad based across retailers and China across the board. It's a contributor, but it's broad based strength of retailers.
Focusing on China for a moment, Bill. I mean, this is a unique time in social media more broadly because it looks as though one of the key social media player might be falling away. Do you think more Gen Z will come to you because of TikTok potentially being banned or maybe no longer existing in your eyes?
Is because you're doing something very different from the rest of social media. What's the social media happens? Back in our day, we have 4 intent and purpose. And I mentioned positivity. Shape the seasons enters there as an oasis away from the toxicity they experience on much of the rest of social media. They know social media is largely comparative and performative. And if you look to the Gen Z, why they spend time on tends to still say they go to other places on social media and see what others want to do, what others expect them to be. They were interested to discover what they invest in themselves.
So still seeing just the same sort of chop. This is not the most exciting trading day. Typically Fednesday is not. It tends to be choppy until we get up to the main event. And then you usually start to see some decompression of this price range. Now, in terms of the vol crush that we typically get on Fednesday, I'm not so sure we're going to get that today because skew is not very high. So this is not necessarily a well-hedged market into the Fed, at least from an options perspective. Although when we look at positioning in futures, it suggests similar that we're not necessarily seeing a lot of those hedges expressed in equities, more in the rates market overall. But that tells me that, the typical vol compression rebid that you have after the Fed announcement and the press conference, maybe a little bit more precarious today. You know, you really need the Fed to jawbone more dovishly to kind of get that outcome. Otherwise, I think if we get Powell kind of continuing down this theme, and really the Fed statement continuing this theme of being a little more hawkish, we could see some continuation lower. And I would say S&P 5,000 would be the first stop that I'd be looking for a rebid, just because it's such an enormous area of options positioning. As we can see on the chart here, that's also an area where there's the highest level of put interest today. That's where most puts are transacting, just around S&P 5,000. Now, some folks are trying to say that this is all selling of options. I would take a slightly divergent view of that. I don't think that's really the case, and I would just go and say that a lot of the inference models, unfortunately, don't accurately capture what's happening because they're using algorithms to essentially guess on what positioning is and where volume is going. So I think there is hedging demand ahead of the Fed, but I think we're not well hedged. I think it's just a modestly hedged market. So right now we're looking at S&P cash down 0.15% to 5028. NASDAQ 100 cash down about 0.5% to 17,356. And just a tepid bid in spot vol up about 0.11% to 1568. Earlier today, we got manufacturing data from both S&P Global and ISM that suggested that prices paid continues to rise at an appreciable clip, really something that's not a good sign. We're seeing new orders drop, employment's dropping, business activity is pretty slow, and yet prices continue to accelerate on the input side. And that leaves companies in really a situation where they have to decide, do they have the pricing power to pass that on and create some cost push inflation? Or on the other side of it, are they going to have to realize margin compression, right? So that's kind of what we're seeing. But overall, that ISM data came out a bit stagflationary overall. A theme we also saw in GDP, and a theme that unfortunately is becoming a little bit more likely this year to play out because of all that late cycle fiscal excess that's boosted demand at a time where we're really in a later stage economic cycle. And there's this idea we can just skip past any kind of reset. We don't need a recession. Let's just keep pushing all speed ahead. But, you know, recessions have a purpose. They have a corrective purpose, and it helps to bring prices down, prices of assets, but also real world prices. And without that reset, and with all the demand-inducing fiscal excess of the government fighting the Fed, that just makes it more and more likely that we get back to sort of an overheated environment of inflation and prices rising. We see more and more signs of that. check back in on oil. It's one of the more exciting trading vehicles here today. Trading at 79.47, and so really kind of re-entrenching those losses. We have pushed below the uptrend line. We have pushed below the rebid zone. We are in the cloud. If it close like this, it's looking like we're trendless, and that's going to have us reevaluating some of these trades in oil in the short term. It also does look a little bit like we're confirming a head and shoulders pattern here. So that would be another area to be just a little bit concerned of in the short term if we don't get bid back up. If this doesn't end up being sort of a head fake and then we get bid back up here, I would be a little more concerned about crude going into the later part of this week and next week.
VIK indicating 26.50 now on 3.5 million shares. That's Victor India Kilo.
Block trade and ticker, NCLH.
Definitely an interesting environment overall, just in the big picture. So many things shifting around behind the scenes. And I think that's sort of the theme of 2024. A change of guard, a change of leadership, a market environment where the dynamics of what led us higher in 2023 no longer really intact. That might be bad for tech and growth and some of the more long duration risk areas of the market, but it's good for companies that have strong balance sheets and that they have good free cash flow and that they're in areas where they have pricing power. You've got all three of those. You've got an opportunity. And I think that's the qualifier here. We are no longer in an environment that is going to be incredibly forgiving of speculative risk taking, and it's going to be much more rewarding of getting involved with companies that are really on a solid growth trajectory and have very minimal debt related or growth related risk factors at play. So low debt to no debt, clean balance sheet, strong free cash flow, pricing power. Just mark that up as your list as to what to look at if you're looking to try to gain some kind of credit cycle investing insights or swing trading insights, because that's where we are. We're in the great rotation.
XTI Aerospace a spike in volume, X-ray Tango India Alpha.
Starting to see a little bit of a pull here again in S&P and breaking below that recent low here. So again, we do have some potential magnetism down to that hot put level should this continue. We also see interest building below in lower prices and fading in higher prices in terms of order book liquidity.
American Honda reporting April total sales of 116,586 units, up 0.4%. That's HMC. CVS hearing a downgrade at Leerink to a market perform, Charlie Victor Sandy. CYCC, Cyclacel shares popping here. Charlie Yankee, Charlie. XOMPXD, Bloomberg reported FTC to rule on $60 billion Exxon Pioneer deal in the coming days. That's X-ray Oscar Michael Papa X-ray Delta.
Block trade in ticker, GOLD.
CYCC, cyclic cell, getting moving higher now, $2.82, up 34%. Charlie Yankee, Charlie, Charlie.
So soon reports that the Fed, FDIC and OCC won't completely redo the January 2023 proposal, but officials weigh changes to how market risk is assessed in its plan and discusses finalizing bank capital rules as soon as August.
VIK indicating now $26 on 7 million shares. That's Victor India Kilo IPO.
US Secretary of State Blinken says Israel has made very important compromise over the proposal for the hostage deal, says there's no time for further delay and haggling. Hamas should take it. And US Secretary of State Blinken says we have seen in the recent weeks real and meaningful progress.
Citron. VIK shares are open now. Viking Holdings shares opened at $26. VIK again opened at 26, priced at 24. VIK. Viking 26.79 the high now. Victor India Kilo. Japan weighs regulating AI developers following US and EU. That from Nikkei.
Japan is considering regulating large and domestic and international AI developers.
Final trades on CNBC, CRWD, CrowdStrike, LDOS, Lados, OKE, 10 final trades on CNBC. Coming up at 2 p.m., the Fed rate decision and the FOMC press conference at 2:30.
The White House says there's no response from Hamas on the ceasefire and hostage release proposal. And hostage release proposal. So just a reminder, you can trade the FOMC with us at 1:15 p.m. Eastern Time live today, and our very own Tony will be going over fundamental prep ahead of this release. And hostage release proposal. So just a reminder, you can trade the FOMC with us at 1:15 p.m. Eastern Time live today, and our very own Tony will be going over fundamental prep ahead of this release. And hostage release proposal. So just a reminder, you can trade the FOMC with us at 1:15 p.m. Eastern Time live today, and our very own Tony will be going over fundamental prep ahead of this release. And hostage release proposal. So just a reminder, you can trade the FOMC with us at 1:15 p.m. Eastern Time live today, and our very own Tony will be going over fundamental prep ahead of this release.
Block trade and ticker, CL. 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 Block trade and ticker, CL.
Yep, just had to do a little reset of Bookmap there on my end. So let me just, make sure, yep, it's all rebroadcasting there, so we should be good. Just change some settings, trying to improve performance a little bit, because I know it's going to get really choppy there, and I want to make sure it can keep up with that chop as we get through to Fed time. So welcome everyone who's joining the stream here. This is going to be our FOMC live stream. We'll have the decision live, and we'll also have the press conference live, and then some analysis as well. Should be fun, and by fun I mean educational. But it's an important day overall. It's the most important day of our lives that comes around many times a year, right? In all seriousness, I do expect this to be a Fed that is probably more hawkish than what people may be expecting. I think that we're going to have a continuation of that theme from Jerome Powell, where he sort of turned around and become a little bit more guarded in his optimism for rate cuts. And I don't think he's going to imply that, hey, we're just about to hike's around the corner, but I think he's going to at least allude to that is a stronger possibility than it was several months ago because of the way the data is taking shape. So I think there's a sort of reevaluation of expectations necessary by this market that's only really starting to catch up to this new reality. And we see it in rates. Rates have been ahead of this more than equities, but now we're starting to see equities get some pressure. April is typically a pretty good month for the market, but so far it really hasn't been, right? Now we're in May, and they say sell in May, go away, but honestly, 75% of the time, actually stocks are up in May. So I think that's another thing to kind of take into consideration as well. That seasonality doesn't necessarily imply that May is a bad month in isolation. It's going to be much more about earnings, how they all come out. This week is still pretty important. We've got Apple coming up tomorrow, and it's going to be about the Fed. It's going to be about inflation and other economic data. Inflation data continues to come in really at levels that are concerning. And it's not just in the mainstream reads of inflation. I think that's another important point. Like today in ISM manufacturing and S&P manufacturing data, we had prices paid much higher than what we want to see. And for manufacturers, that poses a difficult question. Do we hike prices, and do we have the power, the pricing power to do that? Or do we eat that and take narrow margins? So I do think it's important to take all this information into consideration in terms of us being longer term traders and investors. Obviously, if we're day traders, it's a little bit different. A lot of these opinions are expressed in timeframes of minutes or hours, but over the longer term picture, a lot of that macro and fundamental data does matter. It does take shape. If you look at the stocks that have had the best performance, it's no coincidence that they're often the ones that have the strongest earnings. And in terms of the macro tailwinds, I mean, first I'll repeat myself a little bit, but I hear a lot of people kind of say everything macro is bearish, and so we should just ignore macro. Macro doesn't matter. I've heard that so many times, and it couldn't be more wrong. First of all, the macro is generally more bullish than bearish a lot of the time. Secondly, macro takes a longer time to play out than a lot of other catalysts. So the folks that have an attention span of a goldfish aren't going to necessarily see that. But over longer time frames, it actually does matter a lot. But you can't just look at the Fed in isolation and say that's all macro. And, because last year the Fed didn't necessarily get their job done, that all macro doesn't matter. That's not true. The government fought the Fed all year long. So the macro mattered because fiscal excess outweighed monetary tightening. And that's something to be cognizant of. So I think we're in a bit of a environment that requires us to
results
pay attention
of the Fed reverse repo operation.
That sort of change in guard, right? Last year was the year of fiscal excess and stimulus and fighting the Fed, and it worked to stave off a recession. It worked to build back demand, but now we're in a period of time where the demand from that fiscal excess is creating inflationary pressure, which has been my concern the whole time. I kind of felt like a recession would have been helpful. In fact, American families would rather see a moderate recession than persistent higher than normal inflation levels, right? And I think that's another thing that will probably be a lesson to a lot of people.
69 counterparties take $438.148 billion at the Fed reverse repo operation.
So it's interesting to kind of take into consideration, some of the things that are happening underneath the surface. The consumer is starting to show real signs of stress in those bottom two quartiles. It is a very much K-shaped economic environment. And I think we have to be cognizant of that, because where we invest, what kind of consumer group or what kind of other influences in these companies is going to have a big impact on their overall outcomes. Like, you do see more and more companies, their earnings citing weaker consumer demand. That's a real thing, but it's really focused on the bottom two quartiles because the bottom two quartiles are struggling. They've got record credit card debt and interest payments. They have income that's risen, but not as much as their overall inflation has. And you have policymakers that don't seem particularly concerned about this, and that's helped to actually reinvigorate the animal spirits of inflation and demand in other areas of the economy that are further pricing people out. In fact, because home prices have risen as much as they have, and now mortgage rates are on the rise, we're back to record levels of housing unaffordability. You've got a whole generation priced out of the American dream, which is one reason why birth rates keep falling. Who wants to form a family when they can't afford to buy a home? That's a serious thing that we have to contend with. And this is where I say, we're supposed to have an economic cycle. It may not be convenient to have a recession, but it is a healthy part of the reset. And it seems like we've almost taken that off the table for now and instead prefer to just sort of power through all of this with a bunch of drunken sailor levels of spending. And you say, well, how do you know it's that aggressive? And it's because the percentage of deficit spend I would say the percentage of GDP that this deficit spending has been is the highest ever with unemployment this low. So that gives you a sense the economy did not need the amount of support it's gotten, and it's become excessive, and it's stimulating demand in ways that are not sustainable. So I think that coming into the Fed has every reason to be patient. They should hike. I don't think they will, but they should consider it because, quite frankly, we're not through this inflation. Now, if the government didn't get in the way of the Fed last year, we'd probably be on the other side of this. We probably would have had a short and sharp recession, would have been able to correct a lot of prices in real world goods and services and assets lower. We would have seen, unemployment come up, more slack in the jobs market. A lot of these things that are feeding inflation now wouldn't be concerns. And we have lower deficit spend, lower debt, and we'd be coming into this year having hit that reset button and be in much better shape. Instead of doing that, the infinite genius of sort of modern monetary theory is, we can just control the business cycle. You can't control the business cycle, but the business cycle eventually can get pretty grumpy, right? So for the short term, they can pull it around, and that's exactly what they've done by flooding the system with money. But then the concern becomes, okay, but what if there is a slowdown in the economy? What ammo is left to address that, right? Especially on the fiscal side. And it's going to be a bit more of a challenge. I mean, if the Fed cuts rates this year it doesn't necessarily alleviate the interest burden on the US government's debt either. This is a nuanced part of the conversation that is not being discussed in larger financial circles. And I'm puzzling over why, because it's not like it's this far-fetched scenario that the market doesn't behave the way the Fed wants it to. That's exactly what happened all year last year. So why can't it happen on the other side? The Fed tried to tighten, the government fought them, and the market fought the Fed successfully as well. So on the other side of it, when the Fed cuts, if inflation is higher than what they want to see, assuming they do cut, it may not have the same impact across the yield curve, particularly the shorter end, where their policy has a greater effect than what we may, otherwise expect to see. That is to say, the Fed, they're not irrelevant, but they're also not the entire market. And I keep coming back to this because it's an area that I think we need to gain greater appreciation for as this whole system becomes a little murkier.
At 1:30 p.m. Eastern Time, we expect comments from ECB's DeCoz, who gives a speech on monetary policy and inflation in London.
So for me, the way I'm looking at this whole scenario is just through the lens of, I think the Fed still matters. I think that they have tried through their limited set of tools to slow inflation, and they've in the process managed to kind of create some other issues, right? Interest burdens for many are very high, small businesses, consumers, property owners, everyone in any kind of revolving debt, and of course the government itself. And on the other hand, they haven't really succeeded in subduing the froth in asset markets, the bubble in the housing market. Jerome Powell being the first Fed chair I know of who ever called the housing market a bubble and also said to expect a reset, one he never accomplished, I might add. And I think that, a lot of that has to do with the way the government leaned in as heavy as they did. Because yes, interest rates locked people into their existing homes. But if we had, again, it's not pleasant, but a bit of a flush, a bit of a recession, people would have to get out of those homes anyway, even at higher rates, and maybe downsize. And there was room for housing to have a correction in that type of an environment that all this excess demand helped to sort of alleviate. I also think it was reckless and irresponsible for the Fed to ever buy mortgage-backed securities during the COVID crash. There was no housing crisis then. There was no reason to get that involved with that market. And now they have a whole bunch of MBS that they have to try to, either roll off, which will take like decades in many cases, or at least a decade, or they have to sell it, which they've been talking about increasingly. Like if they're going to taper QT, they've talked about kind of selling off MBS and buying bills as a very strange cross-asset operation twist. I don't know that they'll be able to find the market to sell those MBS without jacking up rates even higher on mortgages. I think it would have been better if they just never interfered with the mortgage market, but we are where we are, and we've got to operate in the market that we have in front of us rather than what we may have wanted to see. So good question out there. Higher for longer is worse than just cutting rates sooner, or is it the other way around? So I think that higher for longer would have been fine, and we would have been through this mess already if the government didn't fight the Fed. Now that the government's fought the Fed as aggressively as they have, it's more of an issue that if they cut, it could reinvigorate further this underlying resurgence of inflationary pressure. So I almost think they don't really have much of a choice than to remain down the path of higher for longer, or what I've been calling climbing Mount Higherest for longerest, right? This idea that they just kind of have to keep going down the path, because the alternative is if inflation creeps up because they cut, the Fed further loses control of the narrative around rates. The market starts to further discount the Fed's impact on rates. And that's kind of a dangerous scenario, because we've already kind of gone through that on the one extreme last year. And again, we could go through it on the other extreme this year. So I think the other thing is the Fed needs to be sort of cautious about how much of an impact do they have on markets, right? And if they're perceived as not having as much of an impact as they want to be perceived as having, then that could be harmful for their ability to effectuate policy outcomes. So hopefully that's helpful. Let me know if you have any follow-up. And then Al remarks, that's all fine, Mayhem, but we all know it's Jerome's tie color that determines today's call. Well, that's a fair point. Just like it used to be the size of Greenspan's briefcase that would tell us, what's on his mind and what policy decisions are we going to get. Well, of course, with Greenspan, he made every effort to not tell you anything. And with Powell, sometimes he's very transparent. Other times he doesn't really seem to have a good grasp on what he's saying. But, I really respected his transparency during COVID and all the way up through like late 2022. Then I think it started to slip a bit and he started waffling around a lot more, particularly starting in Feb 2023, all the way through, the January meeting of this year, where he was kind of sanguine about inflation and seemed to be looking at measures of financial conditions that were different than what everyone else was seeing, and, made a lot of determinations based off that didn't make a lot of sense.
At 1:30 p.m. Eastern Time, we expect comments from ECB's Decaux, who gives a speech on monetary policy and inflation in London.
I agree. A big word salad has been the theme lately. That's something someone said in the chat. And yes, it exactly has been more obfuscation and more, sort of waffling around wishy-washy stuff. We're all very data-driven.
Israel's preparing for an offensive in the north, according to the military chief.
We hear that data-driven mantra over and over and over again. And we get it, but we also know they're looking at backward-looking data, and that may not necessarily give them the input they need to make a good decision in the present. We also know that they have the wherewithal and the financial, kind of plugged into all these different areas of the economy. They have all this computational power. They get all this near-time data. They could make better informed decisions than they do. We kind of know that. We also know that, CPI, what is it really? It's just a survey of prices in a lot of different metropolitan areas for the most part, right? Why can't you just automate that and have it in like near time, like 1 day latency? Sure, it'd be noisy, but you can smooth it out on a weekly and monthly and quarterly and yearly basis, but you don't have to wait a month to get it or wait 2 weeks to get it. Like, why wouldn't that be possible? It takes all the subjectivity out. All of those data feeds are available. There's literally no reason we couldn't have a near-time inflation index that's accurate. And with today's technology and all this leaning into machine learning and analytics and, interconnectivity of all this data, there's almost like no reason not to do it in the near term, right? That latent data is not helpful. And then PCE takes almost a full month to come out. The same thing is true there. That's all based on consumption. That's all data that could be compiled much more rapidly. This isn't all just like a bunch of people doing it on graph paper and spreadsheets by hand anymore. This could almost entirely be automated, and you could even take some of the human element out of the surveys and just query retailers directly. I don't see any reason not to do that. So I do think that this is a challenging time for the Fed overall. They're walking a bit of a tightrope. Almost no matter what, they're going to make some kind of policy mistake, right? It's just like, in which area do they make the policy mistake? Do they stay tight for too long, or do they cut too early? Now, if you rewind back to Jackson Hole of August 2022, one thing Powell repeatedly emphasized that day and from there forward was this idea of, we're okay staying tight for too long. We have the tools to fix that with our policy. But then he started walking that back in later 2023, when the Fed started to become much more sanguine about the potential of inflation coming back, and and about where financial conditions were, because at that time financial conditions were easier than when the Fed had started tightening, almost as if they had accomplished nothing of any value. So I think that it's a very interesting sort of inflection point we're at right now about the efficacy and relevance and credibility of the Fed, and the increasing likelihood that really no matter what they do, it ends up being a policy mistake for some part of the economy. And that's kind of how it's always been in some ways, right? Like the Fed, I've liked to joke for a while, the Fed has a different dual mandate.
Shortly expecting comments from ECB's Decaux.
It's this idea of creating and destroying bubbles. That's the other Fed dual mandate that doesn't get talked about quite as much.
US State Department says Russia breached global chemical weapon ban in Ukraine war.
So we're about 30 minutes away from that Fed policy decision coming out. We'll have that live here as well as the live stream of the market reaction. And folks, if you're tuned into the stream and you're enjoying it, give my pinned tweet a retweet to others. Give it a like, a reply, whatever you'd like. You're also encouraged and welcome to ask questions. You know, this is supposed to be helpful for everyone. So let's see. For the FOMC, it would be possible to zoom out so you can see the changes above and below. And will I be live? Yeah, I will be live. And, you know, we'll just zoom out a little bit in the here and now to show where liquidity is. Right now, we have the second most active call strike correlating with a pretty large resting offer overhead, just around 50.82. Then we have the Uber area of offer just above 5,100, and above that, the hot call strike. All that data on the right column from my advanced SPX options visualizer plugin that goes through 10,000 different options in the S&P 500 index options chain every minute and updates that data, both in terms of the flow and the overall positioning. So it's an easy way to see that inside of Bookmap. One thing that you can expect going into the rate decision is that liquidity will evaporate in a lot of places pretty quickly. That's something that I think is important if you're trading this, to gauge your expectations reasonably. You're not necessarily going to get the same sort of fills you would get during normal market conditions. Like this whole heat map, all this liquidity you see near spot price, it pretty much vanishes right before and even during an event. And that means you get much more slippage, you get more volatility. And so you have to be a little more careful trading into that environment. It's why a lot of people kind of sit on their hands during Fed Day, or at least take smaller size positions and try to be more careful about risk management. When do you think we'll break the October 22 lows and then the COVID lows? Boy, that's a tough one. I take it one day at a time. So I don't really have a firm timeline as to when that may happen. But I would say that a lot of this has to do with the fate of the mega caps, because they've been what brought us up above those October 2022 lows. And so if their earnings growth trajectory is sustainable, you know, we should be able to float above those lows. But if we start to see that called into question more, then I think that becomes a greater concern, because really there's been a lot of concentration and price discovery to the upside in those names, driving a good amount of it to the point where now I think they're something like 30% of the S&P 500 market capitalization. And so the question becomes, on the other side of that, you know, if you have another year like 2022 where inflation's coming back, rates are moving higher, and the market rolls over, then those mega caps could lead things lower. And that's where the real concern comes in. Like if they're not seen as a place that's safer, if their earnings and revenue growth isn't seen as sustainable, that's where I would be very careful about risk management to the downside, because at the index level, those mega stocks are going to be the biggest impact on price discovery up and down. And on the other side of it, you can have stealth bull markets in sectors and industries, just like you can have stealth bear markets in sectors and industries. So in 2022, energy was in a major bull market, even as the market rolled over. So the other thing I would just say is, even if the market's rolling over, even if it's making lows and retesting these prior low levels, it doesn't mean that there won't be some parts of it that may not do well. There also could be other asset classes that could do well in that environment. And I'm thinking of commodities and different types of emerging markets that are commodity heavy. So I would just be cautious to try to predict. I think for trading and investing, it's more about probabilities, and going all the way back to the October 2022 lows, trying to visualize that from where we are sitting right now is a little more difficult. But I think there's a series of events that if they played out, then the chances of that happening would be stronger. And the biggest one would be, kind of a big disruption to the mega cap growth theme. That's been one of the underlying drivers of this. The other two pegs have been removed. One of them was disinflation. We've turned to inflation. The other one was sort of, rates coming down and the presumption of the Fed cutting. That's also kind of come off the table. Maybe we get one cut this year. So 2 out of the 3 pegs of the stool, not looking so good. But the last one is the mega caps and their earnings. And overall, they've still been relatively strong.
ECB's DeCoz says Eurozone inflation will fluctuate for the rest of 2024, then fall to 2% target in mid-2025.
Let's zoom out a little bit again to see some of the areas of interest here. Got a very, very large resting bid. This is the largest I see on the chain here, down here at about 49.5825 or so. So that's more of like a floor rather than a magnet, but it is interesting to see that nevertheless. We've also got these large resting offers overhead, including right where we are on price. We have the midpoint painting in the advanced SPX options visualizer, which is just telling us that we're sort of in a market imbalance here in terms of the options driven auction.
And ECB's Decos says transmission in the latest cycle is also stronger than in the past. And Decos says, I'm increasingly convinced we're on the right track to reach 2% soon. Decos says disinflationary process is advanced but not yet complete.
And to the credit of the ECB, they've actually accomplished a lot more than the Fed. And they've walked a tightrope.
Coming up in 20 minutes at 2 p.m. Eastern Time, the FOMC rate decision, and at 2:30, the FOMC press conference.
Yes, iceberg alert. By 1006.
There's some talk that the Fed will announce that they're going to begin tapering quantitative tightening today. I'd be very surprised if that ended up being the case, because near term, I don't really see a reason for them to have to do that with where the reverse repo market and bank reserves are. Reverse repos over 400 billion. Bank reserves are something like 3.4 trillion here. We can see there's a bit of a convergence level between VWAP, point of control, and the second most active put strike. This has become a bit of a key level to watch here. And then we have the most active put strike down here at what will correspond with SPX 5000, which I think is a pretty key proving ground for the market. Really needs to hold above there, or not only do we get a bigger volatility trigger, not only do we go deeper into negative gamma territory, but a lot of these CTA models and other systematic managers also have more to offload just below there. So it's going to be pretty important. If the Fed does announce a tapering of quantitative tightening, that'll probably be well received by the rates market and the equities market overall. But on the other side of that, if we get a more hawkish than expected Fed, which is what I think overall is the baseline here of what expectations are, is that it's going to come in hawkish, but it could still come in more hawkish than what the market expects. I do think that risks further upward pressure in rates and a bit more of a reset in equity pricing, not only today, but over days to come as well. Going into this, this is not a particularly well hedged market overall. Skew is lower. Short interest isn't particularly high in a lot of areas. Net exposure by hedge funds, net long exposure is at multi-year highs, as is the long positioning of asset managers and leveraged funds. So there are a lot of folks that have a lot of risk on into this environment. Let's take a look at rates ahead of the Fed decision here. You can see the 10-year note futures pretty much flat recently, but overall a bit of rate relief. Gold ahead of the decision, and usually Fed weeks are pretty bad for gold. Just chopping a bit, pretty flat overall. Bit up just over 1/3% here. We've got crude oil, which is struggling to hold on to
At 2 p.m.
79.
Eastern Time, we get the US interest rate decision. Forecast no change on the prior 5.5%. We also get the FOMC rate statement. Looking at some analyst notes ahead of this release, Unicredits say the Fed will very likely leave interest rates unchanged at the conclusion of its two-day meeting. We expect it to announce that it will slow the pace of quantitative tightening starting in June. Chair Powell is likely to reiterate the central bank is in no hurry to cut rates. We expect a total of 75 basis points of rate cuts this year, starting in September.
Yeah, I don't think we're going to get quite that much. My own take is maybe we get one or two, but
And from Societe Generale, at this FOMC meeting, the market will be looking for clues for further hawkishness from Powell at the post-meeting press conference and for changes to the statement that might acknowledge sticky inflation. A slowdown in growth and a decisive shift in the disinflationary trend are throwing a wrench in the Fed's easing bias.
that it is. Bitcoin down over 5% today. Just looking at that on FinViz, it's been pretty brutal. It's now looking like it's in a downtrend. It's made a new lower low. It's below the volume-weighted Ichimoku cloud. So I'd be a little concerned about the cryptocurrency. I heard all kinds of bullish stuff about it, about the halving and about the ETFs and otherwise. But right now, it's still looking pretty precarious. So I would be a little bit more careful on Bitcoin overall. Let me see if I have the other chart that I made earlier for this. Yeah, so this is the one where I'm kind of seeing it in a zone of decision. There's not a lot of volume profile here. If we don't see this thing get rebid kind of aggressively like it had on these other look belows, even going back all the way to earlier in March, then there is some chance it could head down to around 51,960. So that's kind of what I'm looking at Bitcoin. So far the path of least resistance seems to be lower, and it really feels like there was a lot of front running of the halving event. The other thing that's interesting about this whole paradigm is there is a limit to how much the Fed can really do. They have a limited set of tools, and for their tools to work properly to subdue inflation, there needs to be some degree of agreement from the market and some degree of support from the government. And we got neither last year, which really made the Fed's job a lot more complicated for them. So I think that's another thing that's kind of an interesting point to consider, that, the outcome here would have probably been a lot better if the government didn't spend so much time and money fighting the Fed.
previously, and as big talking about financial conditions, the expectation was that you would see material slowdown in the economy. It just hasn't happened as of yet. And even though we didn't slow down in Q1, the GDP growth at 1.6%, if you look at the domestic economy, you know, consumer spending, residential investment, capex, it grew 3% annualized, so very sturdy number. You know, the consumer printed 2.5% in the first quarter. So I think
one thing that we do often see as it pertains to geopolitical tensions is they don't necessarily get priced in the same way later in a conflict that they do earlier on. And some of that's probably one of the reasons we're not seeing headlines coming out of Israel and this conflict they have with Hamas affecting the market the same way that it used to. It's like a growing degree of complacency when the war doesn't boil over into something worse and lessen until it does.
So in 10 minutes time at 2 p.m. Eastern time, we get the US interest rate decision forecast, no change on the prior 5.5%. We also get the FOMC rate statement. Looking at some more analyst notes, Morgan Stanley say we expect the FOMC to keep the Fed funds rate unchanged. Little change to the FOMC statement is expected, but we see the risk of a more hawkish press conference given Chair Powell's recent commentary on the lack of progress on inflation. The emphasis should be on remaining patient as the FOMC awaits more convincing inflation data. Wells Fargo says stubborn inflation and resilient economic activity through the first few months of the year have left the FOMC little reason to ease policy in the near term. In addition, a chorus of Fed officials, which tellingly include a number of doves, have indicated that there is no hurry to cut rates at this time.
That's something that's important to consider. A lot of the former doves are not in favor of cutting here. So that consensus that, you know, hey, we've got the all clear, that's been thoroughly walked back. It looks a lot different at this point. So we'll probably start to see liquidity thinning out here ahead of the Fed decision. We'll take a look above and below here on where we are. Going into the Fed decision, Fed funds futures are pricing in the chance of about 22.6 bips of cuts to start in the fourth quarter of this year.
Iceberg alert by 1,000.
We can see liquidity beginning to thin out a little bit just right around spot pricing here. You can see that in the heat map as we approach the Fed decision.
At 2 p.m. Eastern Time, we get the US interest rate decision. Forecast no change on the prior 5.5%. We also get the FOMC rate statement.
And continuing to see that liquidity thin out even more. It's almost become dark here ahead of the Fed. This is why, again, caution is warranted trading these events. The risk for slippage is much larger when there's not much liquidity. It makes it more likely you can gap up and down pretty significantly. So I'll zoom out to show just these largest resting offers and bids as we get closer. Yeah, just market makers just pulling back. They don't want to take risk into events, and even though that's their job to take risk and to make markets orderly, they pretty much just remove all the liquidity ahead of event volatility catalysts. And so, you got to be cautious as a market participant playing with fire in that situation. Doesn't mean it's untradeable, but it means if you're going to trade it, small size and wider stops are necessary. So we're going to zoom back in just a little bit here. We do see a little bit of liquidity above and below, but you can see how much it has thinned out over the last 5 minutes here. And we're just balancing right above the point of control in VWAP ahead of the Fed decision. Right around the second most active put as well. That's a convergence level of 3 key areas. You see a lot of selling delta below us. So sellers, if we do push meaningfully higher, are going to be offsides. Right now, the buyers that were coming in are a bit offsides. This is going to be a pretty important decision point to determine the trend for the rest of the day. And often is the case, you'll get a head fake because there's just no liquidity anywhere. So be careful trading this, folks. Just about less than a
1
minute.
minute remaining.
Here we go.
10 seconds.
Can you feel your blood pressure rising?
No change, no
Iceberg
change. The rate
ESM for
remains
CME
unchanged
buy
at
at
5.5%
5,052
as
points to 5
expected.
crossed 500. Yes, Iceberg alert.
Federal Reserve
Buy 1,000.
maintains mortgage-backed securities redemption cap at $35 billion per month and will reinvest excess MBS principal payments into treasuries. The Fed will slow the decline of balance sheet by cutting treasury redemption cap to $25 billion per month from $60 billion starting in June 1st. The Fed will slow the decline of balance sheet and
Hold on.
Fed says economic activity continues to expand at solid pace. The job gains have remained strong. Unemployment rate has remained low. Fed says risks to achieving employment and inflation goals have moved toward better balance over the past year, as opposed to are moving into better balance in the March policy statement. Fed does not expect there will be appropriate cut rates until it has gained greater confidence inflation is moving sustainably toward 2%.
Whoa, we got a taper. We got a taper.
Fed says inflation has eased over the past year but remains elevated. The vote in favor of policy was unanimous.
We have a taper.
US short-term interest rate futures contracts rise after Fed releases the May 1st FOMC statement. US stocks gain some ground. S&P 500 last down 0.1%, pairing its losses. US Treasury yields trim losses after Fed. 10-year yield last down 3.5 basis points at 4.642%.
Yes, Iceberg alert. Buy 1,009.
That is
yes, Iceberg multi alert. Buy 2004. Yes, Iceberg alert. Buy 1007.
That is a interesting outcome with the taper here, and we do see in 10-year note futures a pretty violent reaction. You got to zoom in quite a bit to see
Traders
that.
now see the Fed rate cut most likely in November.
Just parsing through all this data and taking a look at Fed funds futures and a couple of other fun things here.
The Dixie dropped after the FOMC statement, currently down 0.22% on the session.
So, summarizing what's happened here. We had a big
Oil
cut
futures
to
also
quantitative
extending
tightening.
losses. US crude prices down by $3 a barrel.
We had a tapering of the balance sheet runoff that was pretty big. I think that's noteworthy. We have no change in interest rate policy. We're reinvesting proceeds from MBS into buying back Treasury exposure. And right now, Fed funds futures are pricing in the chance of a single cut in November. That's the highest likelihood. And they're looking for about 23 bips of a discount. So we see a bid on the longer end here as they're slowing their rate of quantitative
So
tightening.
traders see a smaller chance of no Fed rate cut this year after the FOMC meeting. US Treasury yields now extending full 10-year yield last at 4.632%, down 5.6 basis points.
So yeah, we do see a positive reaction in rates markets, and this tapering kind of is a more dovish outcome than I think some would have expected. So I think that is initially why we're seeing some of the reaction we are in rates, in currencies, and in equities right now. And then I would go through the press conference and get a better idea of what Powell himself has to say. But this was not entirely expected. This is a more dovish outcome in terms of policy, particularly as it concerns balance sheet runoff. It's also interesting to see the Fed slow QT during a time where progress against inflation is actually not going as hoped.
And US Treasury 2-year yields fall, last down 6.1 basis points at 4.985%.
And we still don't have liquidity really coming back into this market. I mean, look at where we were before and look at where we are now. Yes, there's a bid at 50, 55, but other than that, we're still in no man's land. So careful trading this right here. It can move violently in either direction, especially if anything unexpected plays out. So, we got the statement, the market's parsing the statement. The big surprise here is quantitative tapering. They're slowing the rate of tightening. So that is, in effect, I wouldn't call it easing, but I'd call it a reduction of tightening pressure. And so far, that's been well received. In the 10-year note, we can see that overall it got a bid off of that. There was some iceberging into that. That is to say, there were some larger institutions selling into that, absorbing some of that buying pressure. Now we've reset some of those gains, but overall a positive reaction across these markets to this idea of the Fed slowing QT. And I don't think the market necessarily expected that. I didn't expect them to slow QT today. I thought they might put that decision off because there's really no imminency here. But clearly the Fed believes there is a reason to do that. And I expect that in just about 23 minutes, we'll hear why. Market doesn't really know how to make heads or tails of this so far. Really not a lot of price action here, just sort of chopping in a narrow range, like a 12, 13 handle range on SPOOs. Let's see what's happening over in the gold market. Gold getting a little bit of a pop off of this decision, which is to be expected here. Let's check in on crude. Crude slipping below $79 a barrel. Let's just quickly check in on my crude chart that I put together earlier, and we've been talking about that sort of head and shoulders meltdown that has some room to continue lower. As soon as we chop below this trend line, I started talking about point of control, maybe even a move down to 77.60 or 77.58 being more likely. I didn't think it was all going to happen today, but that is a pretty big move lower in crude, and that's the area I'd kind of expected to rebalance back into this chop zone for a bit, because we have violated the uptrend, and it doesn't look like this is going to be a head fake here. It does look like we're going to close in the cloud, trendless, and with more room to potentially explore lower. So this could be an opportunity, but we need to see how it shakes out. There's no reason to get too aggressive here. It's every reason to wait and see how this plays out. And if we get a rebid down here, then I'd start looking for opportunities in crude again. So, you know, I've been talking to Aisha about this, the Fed decision a bit, because we always like to discuss this stuff and kind of get a feel for what all it may mean. Two thoughts that we have off the top of our heads as we digest this, and we'll provide more as time goes on. She's on TV actually right now, so we're just chatting back and forth before they bring her on. But her thought was that this is also to balance the hawkishness in rates, which I think is a very valid point. And then I added to that thought by also saying, and also to help to sterilize some of the liquidity issues in treasury markets, which I think is something that, you know, both the Treasury and the Fed are interested in making sure treasury markets don't get disorderly. And we both agree this is a bit of a policy mistake either way. So just initial take, a big slowdown in quantitative tightening during a time where inflation is not making the kind of progress that they'd want to see. And the main issues seem to be more related to plumbing than inflation or unemployment in terms of why they may be doing this. We are seeing now markets start to rebalance around this point of control VWAP level. We're seeing liquidity building up again. We've kind of gone through the dark period of no liquidity. We're getting back into a zone of greater liquidity, although I wouldn't call it great liquidity. You can see the order book depth is about 54,000 contracts across the entire S&P. And when we zoom out, we can see not much has changed on those longer term bids and offers that we've seen through much of today, if not longer. On the other side, however, we do have this new bid down here at 50.50, 647 in size, and this new offer just around 50.65. So sort of this implied 10-point range between this new bid and offer that have just come on as liquidity starts to return to the S&P 500 futures. And someone in the chat says maybe a little support of Japanese yen. I mean, certainly, I think the swap lines are one way they've tried to help with easing that sort of funding pressure. I think, you know, there's every interest to make sure that Japan doesn't sort of go off the deep end. So I don't see any sort of imminent economic calamity from Japan. I've always kind of called it a slow motion car crash, because that's kind of how it's played out, right? It's like not like, oh, we're going to go down an elevator shaft ride lower. It's more like, you know, slowly over time, the issues there are intensifying. And the currency is now the greater issue. Before it was deflation. I think there's still a lot of work for Japan to do to try to figure out what their future looks like. But I don't think they've resolved any issues in the yen. Obviously, the market doesn't either, because it continues to punish the yen overall. It has a little bit of a bid today, but you can see that intervention is not looking particularly promising. It may not hold. On the other side, someone says, looks like indecision to me. Yeah, it is in a way what the market is showing us in terms of its reaction to this. It's more indecision. Let's zoom out. Here's like the whole trading day. We've basically done nothing, right? We've just sort of chopped in this 25-point range or so all day long. So it is so far a bit of a nothing burger. I think it will get spicier during and after the press conference. That's my 2 cents. We're sort of coiling up for a bigger move. Now, maybe that move doesn't happen today, but I do think we're coiling up for some kind of a bigger move. And this was also an FOMC event that markets were pricing it in as if it was going to be a much bigger mover. Now, obviously, it's not over yet. But Citigroup put out something saying that, you know, the implied options positioning going into this was saying it was going to be the most volatility that the market was anticipating since 2023 for an FOMC presser. So it's interesting to see so far opposite of that. So we see that lower bid dropping down to 50-50 from 50-55 in similar size. We're still in this range, but now it's about a 15 handle range. Let's take a look at the NASDAQ here for its reaction. It's just a festival of choppiness. But again, if we zoom out, this trading day has kind of been just that. We're just sort of trading in this giant range, kind of peaked above, looked at it, came right back down. So no real decisiveness in any of the equity markets overall. Let's take a look at the Russell. Russell, very similar look. And let's just check back in with our buddy crude, which is struggling to get back above 79. Pretty brutal move there in crude so far. Maybe a bit of a reset here. Maybe it turns into an opportunity. We'll see as time goes on.
At 2:30 p.m. Eastern Time, we get the FOMC press conference with Chair Powell.
We will be broadcasting that live on YouTube and Twitter. So you don't have to, turn on the TV or go to another site. You'll actually be able to get it right inside Bookmap. I'll embed it so you can see it right there. So we'll just get ready for the press conference by just putting a little window here in the corner. That's all of the screen real estate that Powell's allowed to take up. Real estate prices are very high right now, so I'm being as generous as I can.
Consensus is right, and that 240 to 275 range, you have to majorly undershoot that. You need something that changes the overall narrative. And people like me would need to say, oh, looks like the contract affected services employment is over, so the labor market looks fundamentally different. It's a pretty big world. My game from Bank of America, I came to say, wait to catch up with you. My game from Bank of America basically is going to be that first club. Mohammed, I want to come to you on that. You've talked about how sensitive this Federal Reserve is, from data point to data point. Do you think this has the potential, this conversation has the potential to change quite fast in the other direction?
Just about 6 minutes out from the FOMC press conference with our main man, Jerome Powell. He gets to explain why they are tapering QT and to such an extent, and maybe give us a better sense as to what's going to happen with rates. Swaps market's currently pricing at a 25 bips cut in November for this year as the most likely outcome and potentially the only cut, with only about 23 bips of cutting priced into Fed swaps right now.
At 2:30 p.m. Eastern Time, we get the FOMC press conference with Chair Powell.
Now we're seeing a bit of a bid taking us through that resting offer at 50.65 on S&P, just minutes ahead of the press conference.
S&P 500 turns positive ahead of Powell's conference, last up 0.1%.
Got a pretty big bid going into this press conference, just about 2 minutes away. And we've seen S&P futures pop by about 13 handles through that area of resting liquidity and up into this larger area of resting liquidity above, just minutes before the Fed is set to start talking. We will bring you that conference live on Twitter and YouTube. And in fact, we're just going to unmute it here so we can take advantage of the really optimistic hold music. Doesn't it sound like everything's going to be amazing? This is very uplifting stuff.
Shortly expecting comments from Fed's Powell.
So if you believe the tone of this music, then this is going to be like the best press conference you've ever seen. Exactly. As someone says in the YouTube chat, it's like singing along to the song, inflation is transitory. Doves fly, the market's going to 10,000 on the S&P in the next week, and the economy is going to be amazing, and everything is just going to be absolutely brilliant. Your imagination is the only limit. Now we're doing something a little more subdued ahead of Powell. He probably specifically requested this. He's like, tone it down just like a little bit a minute before I come on. It can't sound like I'm going to come out there with wings on and just sort of flutter into the room. And here is the chairman himself. probably. Certain kind of soft power keeping the entire world waiting. There's the big man. So we're switching over to him.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that, that policy is restrictive.
Sufficiently restrictive, I guess. Is the
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina.
Thanks for taking our questions, Chair Powell. I wonder, you know, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a re-acceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rigger at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's what, or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. So take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. we don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking,
Steve.
Yeah, Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Forrest from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably on 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the 2 mandate goals, and if one of them's further away from goal than the other, then you focus on that one. it's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it. And that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation. And it was, 10% unemployment. It was high single digits inflation. Right now we have very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from, and in addition, I would say, most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year. And last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, you've got more supply, but those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point, you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward. Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell.
Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy, sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation, and the reason why we're having this conversation, is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment. That's called market rent. And you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, you know, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think markets and economies can adapt to it. And I think, we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
You know, I said an unexpected weakening is the way I characterize it. So, you know, and I'm not going to try to define exactly what I mean by that, but, you know, it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. You know, a couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not, frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
Michael McKee about long-term neutral rates, not going to engage it. Asked about long and variable lags, sticking to script. There was no sense that he had entertained a lot of the fundamental debates that are dividing Wall Street in a really serious way, and I'm not sure where that leaves people.
I noticed that off the GDP, where we've got a 1.6% statistic, what we heard interview after interview was domestic final sales was actually pretty buoyant, and that's what he alluded to when he went after the stagflation.
Well, let's be clear, they're not going to cut anytime soon based on what we just heard. The easing bias remains. It's just the amount of price action we've seen over the last couple of months. When we talked about the Fed chair being hawkish, it was hawkish relative to what? We've had this conversation all day. Relative to the previous meeting, maybe. Relative to the price action, where we're priced for right now, very difficult to do. The bar for that was so high, given the fact that this market is only priced for one cut in 2024.
Yeah, this didn't push against that. I mean, this could very much be consistent with only one rate cut, and that's why you're seeing a bigger move, arguably, in stocks than in bonds. Basically, this is the perfect mix for stocks, where people said you just need the tail risk of a hike off the table. He did that, and then you can really go to the races.
When we get to Dudley, I'm going to talk about what wasn't talked about too much, which is the labor economy. What evidence do they need to see in the labor economy to really become accommodative? And to me, that's still really unanswered. I don't think it's claims. Maybe it's wages coming down, a la Tom Porcelli and others, but I just really wonder what the labor dialogue is here rather than the parlor game of what inflation.
TK, you're right, but I would pair that with inflation. I think that's really important.
Well, they have to
Would these hot inflation prints temper their ability to respond to adverse shocks? The so-called Fed put. Based on what we just heard in the last 60 minutes, the Fed put is alive and well.
Basically, stagflation's not on the table. Stop it already. And that's basically what we heard.
Can you set up a course where we have Frankfurt and London question quality brought over to Washington? Can you arrange that?
Would you like me to offend everyone?
No,
Federal Reserve
I'm
News
going to say it
Conference?
right now. There are too many questions that are off topic of the dual mandate of price change. Ethan Harris on fire on LinkedIn on this, and on the labor economy. I didn't hear enough about the labor economy.
I have to admit, I disagree with you.
You're
I
going
thought
to
that they
defend the
did.
press
I
pack.
want to
Ramo
defend
disagrees
it.
with me.
I
That's a
felt
bad-
like after the first two questions, people tried every which angle to get something more. It wasn't happening. Period. Full stop. He was going to say what he was going to say, which is essentially we haven't shifted our stance that much. We're not going to hike rates. Goodbye. See you next time.
Let's speak to a man who's been on the other end of some of these questions. Bill Dudley, former New York Fed president and Bloomberg Economics senior advisor. Bill, what did you make of that performance in that news conference?
I think your interpretation is exactly right. It was quite dovish. I mean, he basically said that despite the news that's come in, economy stronger than expected, inflation not so good in the first 3 months of the year, the whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike. No hint that it's not going to work. So the market reaction, I think, was pretty appropriate given what he said. He basically said, we've got it.
Back to Dudley McKelvey of a few years ago. Bill Dudley, you're in the trenches at Goldman Sachs gaming the labor economy. What data in the labor economy is important to Chairman Powell to really become accommodative?
Well, I think it's the notion that the labor market is really starting to somehow fall apart, and the unemployment rate is starting to rise significantly. He was asked pretty explicitly about that, and he basically said 1 or 2% rise in the unemployment rate wouldn't really disturb him. I think the interesting question is if the labor market really starts to deteriorate, the problem is that the next stop typically is a recession. We've never had a 0.5% rise in the unemployment rate without having a recession. So I think it's, if the unemployment rate goes up a couple tenths, I don't think it really bothers them. But if it feels like the labor market is really giving way, then the Fed will put a lot of weight on that, almost regardless of what inflation's doing.
Bill, you said something. He basically said, we got it. The playbook hasn't changed. Was that the right move?
Well, time will tell if the playbook will actually work as well as he thinks. I mean, my own personal view is that the legs of monetary policy probably are not as long and variable as he thinks. And I put a lot more weight on financial conditions, I think, than he is currently. The fact that people are taking his comments in a very positive way from a financial market perspective means that we're having an easing of financial conditions, which will support the economy. So I think it just reinforces the higher for longer story over the medium term.
He doesn't seem perturbed about that. And he also didn't really deal with a lot of the fundamental questions, as we were just saying, that have been dividing Wall Street. Didn't address the higher terminal rate. He didn't address this question of what would make him really second guess the whole idea of restrictiveness or long and variable lags. Do you think that means he's not thinking about it, or that he has rejected it? Or do you think he just doesn't want to deal with it in the public right now?
I think he's certainly thinking about it, but I think he's basically saying, from his perspective, the evidence hasn't convinced him that they're on the wrong track. So he thinks policy is restrictive, sufficiently restrictive to do the job. So maybe our star, maybe the neutral rate is a little bit higher, but it's not as high as where they are today. So yes, could our star be revised up at the next June summary of economic projections? Probably will be revised up a bit. But policy, in his mind, is still sufficiently tight that he's not worried about that particular variable.
Bill Dudley, Ethan Harris has been on fire, retired from Bank of America, out almost daily on LinkedIn with really intelligent work on trimmed inflation means. Which inflation statistic is most informative now to our audience?
Well, I like to focus on services ex housing for two reasons. Number one, this is the problem where the wage inflation drives the actual outcome in terms of services inflation. And number two, it's not being bounced around by the supply chain normalization process, which is pulling down goods prices. I think one of the things that's probably distorting the inflation news recently is the fact that goods prices came down a lot because of the normalization of supply chains. But if we ignore the transitory inflation on the way up, we also have to ignore it on the way down. So we don't want to overstate that goods price inflation weakness. So I think services sector ex-housing is probably a really important thing to focus on. And, that's the so-called last mile of inflation. And that's the part that's turning out to be more difficult.
Bill, we need to talk to you about the balance sheet as well. So the Federal Reserve announcing today they'll slow the pace of balance sheet runoff starting in June. The central bank to lower the Treasury runoff cap to 25 billion from 60 billion. Bill, market participants right now trying to work out, OK, if QT wasn't bearish, is tapering QT bullish? Bill, can you help me understand? Because we were told it's like watching paint dry. It has been. When they start to undo it, unwind some of it, what does it all mean?
I think it is like watching paint dry. You can see that in the press conference today. There were virtually no questions about the balance sheet. And he made it very clear that the balance sheet decisions are not a part of the monetary policy process of making policy either easier or tighter. I don't think it has much effect, the taper, because the destination is the same. The Fed's going to a balance sheet size that generates reserves that are ample but not abundant like they are today. So we may get there slightly over a longer period of time because we're now running off securities at a somewhat slow pace, but we're going to the same place. And so it really has virtually no market implications.
If you were on the Fed still, Bill, would you have voted for this type of thing, or would you have erred a little bit more, as you were talking about before, about financial conditions easing too much to allow inflation to stay sticky for too long?
I don't think we're at this stage where, rate hikes are warranted. And so I would have agreed with the decision today. I think where I would have maybe differed from Chair Powell a little bit is I would just be a little bit more cautious about the confidence that he's got it.
Bill Dudley, thank you, sir. The former Fed New York president. Bill, fantastic as always. Your equity market fades a little bit. We're up by 0.75%. Lisa, I appreciated the question at the end of the news conference. I'm not sure about the answer. Because effectively what the journalist in that news conference was asking is whether the lack of dissent spoke to a lack of diversity of thought on the FOMC.
Correct. They weren't asking about, what gender and
precisely
what, racial composition is on the Fed. They were asking about pushback, intellectual discourse, and this question about whether anyone was saying, hey, wait a second, maybe we shouldn't be so sure that long and variable lags have the same kind of effect as they have in the past. That, I think, is a legitimate question. He didn't address a bunch of questions.
Out here alluded to, and I think Bob Michael's been leading on this, and I mentioned Ian Lincoln earlier, what if we get friendly data? What if we revert to a disinflationary vector? John, I'm doing some research here, and I mean, I look at the G7 meeting in Puglia
trying to make that
here
happen
in June, and
yeah.
I'm sorry, I got a plane ticket of $3,006, not even close to $7,000 8, 9, 10 months ago. I'm sorry, you get whispers of service sector disinflation, and you're right back to the boom economy, Dow up 500, what it was 10 minutes ago.
I'll repeat the question I asked a little bit earlier before the news conference started. I'll ignore the reference of the Dow. The 3-month average on payrolls is 276. The Federal Reserve Chair has just established, conveyed quite clearly that the Fed put is alive and well. They're willing to respond to adverse shocks, downside surprises, particularly if they emerge in the labour market. Now, I'm trying to wonder, Lisa, what it would take to reintroduce the rate cut conversation. Clearly, they still have a bias to ease, to cut interest rates. Would it be a downside surprise on Friday? Would that be sufficient? What would we need to see to get people talking about a different thing? Not about hiking, about being sufficiently restrictive. After what we've just witnessed in that news conference, what would it take to have a series of guests to start talking about July at the Federal Reserve?
And Jay Powell himself might have said, well, it would take a substantial weakening in the labor market. Does this market believe him? That it really would? Or do they think that just the idea that, yes, quits rates are increasing, see a slight increase in the labor market, and then to Mohammed's point, if you already see the weakness, it's too late. How much does that haunt him at a time where he's really embracing the recovery that we continue to see in the economy?
Mike McKee was in that news conference. Mike McKee has run out of that news conference. He's with us right now. Mike, great exchange with the Federal Reserve Chairman in the last hour. What stood out for you?
Well, I think the biggest thing is that there are two audiences here, or two people or two things that the Fed is trying to address. One is the markets and their perception of what the Fed is doing, and the other is the economy and what they need to do to bring down inflation. And the two things are not always compatible, and that's maybe what you have right now. The Fed is less concerned about how the market feels about all this than they are with setting their own parameters within their meeting of what they think they need to do. And at this point, they don't think they need to do anything. The economy seems to be in good shape. We've seen a little bit of slowdown, but we're supposed to see a slowdown when they raise rates. We have seen inflation stall out. Maybe that means they haven't got policy tight enough, but now financial conditions have tightened, and so maybe that's going to start to work. Bottom line, they don't know what they're going to do, so they can't then give the markets a good clue.
Mike, in the fan distributions of all this data, the probabilities, the outcomes of all this data, is there in place into the jobs report on Friday an ability to get back to a disinflationary vector quickly?
Probably not, in the sense that we don't have any indication that hiring is going to significantly slow, meeting any of the conditions that Jay Powell was talking about for a rate cut. And wages, from all the other measures we've seen, have still been running above inflation. So at this point, one indicator isn't going to do it. It would take much more than that. If we got a significant rise in unemployment for some reason, then that would set some antenna up, but it wouldn't push anybody to do anything at this point.
Mike, we talked a lot about how the key question was going to be whether they were entertaining the idea of rate hikes. Were you surprised that he completely dismissed that outright?
No, I wasn't surprised because, Lisa, you just have to play game theory and ask, what would have happened if he didn't dismiss it? Then all of a sudden you've got people really moving the markets around, trying to price for something like that. At this point, the Fed doesn't see a reason to raise rates because they think that overall the economy is slowing a little bit as they want it to, and it is doing so without rise in unemployment. So things are kind of working out the way they had planned.
Mike McKee, great work as always, buddy. We'll catch up with you tomorrow morning. Mike McKee there, breaking it down for you down in Washington, D.C. That pop in the equity market, getting sold just a little bit. We're still positive, but Tom, only by 0.4%.
Can I go to November 7? November 7 is 2 days after a modest election. I'm sorry, but that's the meeting I'm focused on. November 7 could be wild.
Hey, he was pretty direct about it in the news conference. They do not want to talk about politics at all. Not part of the conversation.
And they want to give the sense that they truly are independent at a time where they're actually being challenged in terms of their independence. The more people start talking about, when people, I mean, the former President Trump comes out and starts talking about the potential for, taking ownership over Fed decision-making, they're going to be that much more adamant about being
I'm waiting for him to address that story that came out from the Journal in the last week. Still anonymous sources around the president talking about these issues. These are big issues.
Don't you feel like people are kind of like spitballing out there and seeing how the people react to it before they really kind of put any emphasis behind it?
Jeff Rosenberg's got things to say about this. Joins us now from BlackRock. He really doesn't.
Not that.
Stick with us, Jeff. I'm not going there. Don't worry. Jeff, it's great to catch up with you as always, sir. After what you just heard, does it make you incrementally more bullish in any way, shape or form?
Well, let's just say that going into this meeting, there was a lot of bearishness and fear that he would come out more hawkish. If you even look at, Bloomberg Economics put out their kind of preview, it was overwhelmingly expecting a very hawkish message. So I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman. He's been very much on the other side, has been one-sided, looking at the glass half full and reiterating, kind of the key point around an asymmetric response function. If inflation is higher, and it has been higher over the last 3 months, okay, we won't cut as soon as we were anticipating. But the questions and people who tried to pigeonhole him on, are you going to hike? Did you talk about hikes? Just deflected all of that, and that was a relief. So the reiteration on the asymmetry, as a result of the reiteration on they believe that policy is sufficiently restrictive. Those are two key things here that keeps a more dovish orientation in the face of some challenging economic data.
Jeff Rosenberg, on Planet BlackRock, is the economy doing okay? Is the real misestimation here a 1.6% GDP, which made a lot of news, but domestic final sales were much, much better? Is it better out there than we actually think? And that's why we heard a dovish Powell today?
Well, I think you have a mixture there, and you've heard it, as part of the exchange during the Q&A. In the aggregate data, yes, 1.6 understates it, because as you rightly point out, if we look at domestic demand, it's running at a stronger level. So the economy in aggregate terms is stronger. But what Bob Michel talked about in the earlier, or Michael, I'm not sure which way you pronounce it, talk about is, there are pockets.
Was that some BlackRock shade?
Is
that what that was?
That was 100%
Over at JP Morgan. Morgan. I can confirm it's Michael. Carry on, Jeff.
Thank you. So there are pockets of hurt going on here, but there are also pockets of strength. So you have a distributional aspect in terms of what's going on in terms of the economic growth side, but clearly the amount of slowing, it was a question in the Q&A, didn't you need to have more pain to get the disinflation? Good news is we're still on the path of the immaculate disinflation, and the growth side is holding up. So I think that's quite supportive here to the risky asset perspective.
It seems like this is more supportive to the risky assets than it is to government bonds, right? I mean, this basically raises the specter of taking a rate hike off the table, which will benefit stocks of companies that have done really well with respect to earnings, but doesn't necessarily give that much of a boost to government bonds that are still subject to higher for longer. Is that kind of your view in terms of positioning on the heels of this, on the margin?
Yeah, and you know, I think we have to segment between the front end of the curve and the back end of the curve. I think this is challenging for the long run in the back end of the curve, right? The Fed is for the most part dismissive of the inflation increase. They're not really taking it in too much into account. The characterization of it was bumpy, what me worry. So that's fine, but if you're holding 30 years of debt at interest rates that, you know, may not sufficiently compensate you if you are at a longer period of a 3% inflationary period, that's a bit challenging and a little bit problematic. I think for the front end of the curve, you know, it's a little bit easier story because you have less exposure because of the maturity and roll down that you benefit from there. But I think you have to be a little bit concerned about the longer run trajectory here, both from what we heard today in terms of monetary policy, but the other side of this, which we heard a little bit this morning in terms of Treasury refunding on the fiscal side, that's a bit more of a challenging environment for back-end duration.
Hey, Jeff, I want to build on that just a little bit. Given how established the reaction function is now at the Federal Reserve, highlighted again by the chairman in this news conference, how do you think yields will respond to the longer end to incoming information, the data on Friday, an upside surprise versus, say, a downside surprise?
Yeah, you know, we're gonna pivot right to Friday, and we'll be back and we'll talk to you guys then. But you know, I think that will very much be more about the front end reaction because that's gonna be about, is the Fed really getting the slowdown in the labor markets, the normalization in the labor markets that they keep talking about, but the data isn't really supportive. Non-farm payrolls not supportive, wages not supportive.
Right.
I'm a little surprised you didn't get more pushback on ECI, their favorite measure. Everybody expected it to go down. It went up. Yes, we can dismiss it. It had special factors. It was a bit more state and local. It was a little bit more union than private. But it didn't go down as fast as the normalization would say. And there is that kind of lurking question. Mike McKee, you asked it. You know, are you not as restrictive as you think you are? And they'll continue to believe that they are restrictive. That's kind of the fundamental belief at this point. The question is, if the data keeps pushing against that, then does the Fed have to make a bigger pivot? Today was not that day, way too soon to get there, and that's why Powell purposefully came out very dovish. But inside the statement, one questioner picked up on, there are a little bit of hints here of moving around. The removal of kind of the implicit forward guidance on the peak policy rate, the implicit promise that the next move would be a cut in the introductory statement. I think that's notable. We'll see that in the minutes in terms of the debate. And what the chairman obviously couldn't talk about here, but next month we will talk about, is the shifting in the distribution of the voting members with respect to their forecasts of economic policy. That you didn't get this meeting, but obviously that's what the markets wants to see. And you can kind of read into the statement and the press conference that there is a shift going on there. It was underplayed. Not really many people picked up on it. He wasn't going to highlight it, but you can see that is going on.
BlackRock's Jeff Rosenberg. Great to catch up with you, sir. The shade of JP Morgan from BlackRock.
Oh, stop.
Do you think they call Rick Ryder?
You know,
over at JP Morgan?
It's a fair mischaracterization. You think that was intentional? That was your takeaway from all the Fed coverage?
Absolutely was that intentional.
Bob,
Are you
Michelle?
joking?
Oh,
of course it was. They don't know who Bob Michael is. Give me a break. This S&P 500 is fading going into the close. Let's bring up the chart briefly. We're up now by only 0.1% at the peak. In that news conference, the S&P 500 was positive by 1.2. Something that sticks, though. Interestingly, here, Lisa, is the rally in bonds, the 2-year still down by about 8 basis points.
It took the prospect of hikes off the table, so that potential tail risk not necessarily there. I thought what Jeff Rosenberg said, though, about the long end was interesting, and we're not seeing it in the price action.
So I think this was pretty interesting overall, what we got from the Federal Reserve. I don't think that it was what the market expected. I certainly didn't expect them to taper QT, but I don't take this as being particularly dovish either. I think it's actually more like what we're seeing from the Treasury with regards to buybacks. This is more meant to kind of smooth things over in the rates market. You know, this is sort of an acknowledgement that there's not enough liquidity if the Fed continues runoff at $60 billion a month in those Treasury securities. And so they've reduced that to $25 billion a month just as the Treasury starts doing their buybacks. And we also see issuance on the longer end of the yield curve still pretty low. So all this is kind of telling us there's just not enough confidence in the overall liquidity in Treasury markets to keep QT going at its current run rate. But it's also not a sign that the Fed is saying, you know, mission accomplished. They're still keeping rates where they are. They don't really have a trajectory as to when they'll be able to cut. And on the other side of that, rolling off QT, like slowing it down, is likely to further forestall when they actually can cut. Because now that part of the policy framework isn't necessarily providing the sort of tightening that they may have wanted to see. And if inflation continues to run above the trend that they want, then I think they still have cause to kind of keep policy higher for longer. And I think we did hear more of that. The market's still only pricing in really one rate cut this year. I think we could get one or two. I also think they may be policy mistakes and could further reaccelerate some of that inflationary pressure. So I'm going to be watching how this all plays out. The Fed continues to emphasize just how data-driven they are, and that gives them the opportunity to have cover to just sort of turn on a dime if they decide to do so. So that's the other thing that I would be just kind of watching that. Sort of fading into the close here. And we know the last 10 minutes can be pretty wild. Yesterday, they certainly were. Let's zoom out and get a context for the whole trading day. We had this big Fed pop, right? Markets are looking pretty good for a minute. And most of that has been faded. Now we're down back to VWAP. And we're getting below gamma 2. And we're just sort of pushing a bit lower here. There's not that much liquidity in the order book overall near price. And we've seen liquidity fade to 48,000 on the entire order book. So that's also another sign there. And yeah, it's just sort of looking like some of that illiquid Fed trading that pushed us higher is being rolled off. Let's take a look at what's going on in the
Market on
NASDAQ.
close imbalance, 1.3 billion to the sell side.
Interesting. That one might actually have an impact. It is big enough. NASDAQ also balancing above VWAP. Russell balancing above VWAP. A little bit of interesting convergence across those three. 10-year note, what is it doing here? Well, it is also giving back a lot of that rate relief, right? You had a big iceberg sale up here, distribution into that strength. Someone was selling pretty big, and that kind of capped things off here. So I think that's another one to kind of look at, those iceberg flows. I always like to see, those large distributed flows as one of the markers of potential move starting to reverse. And we certainly saw that in treasuries today. Checking back on S&P, it's starting to cut back below VWAP here. We do have the second most active put strike just here around the point of control as well. So I think that's an area that, if we see the market not be able to hang on to VWAP, getting back down to that level and balancing out into the close wouldn't be too surprising. We are in that last 10 minutes of trading. And remember, about 30 to 40% of all trades are executed in this last 10 minutes. So it's a pretty important time for price discovery in the market.
Iceberg ESM for CME sell at 5,064.5 crossed 500.
And there you go. There's some of that additional pressure coming back into the close, resetting that Fed move, because maybe it's not bullish after all. Remember, a lot of these, you call them head fakes, you call them Fed fakes, you can make any clever moniker that you want, but a lot of these moves don't last for whatever reason. So we got up
yes,
here.
Stop alert. Sell 1027.
And you saw there was no conviction on either side here, right? We pushed through a lot of resting offers to get there, but then the conviction kind of dropped and sellers started to get a little bit more bold and took control of price action. As we head down here closer to the point of control and the second most active put strike into the close here with just about 7 minutes left. Let's check on the NASDAQ. I imagine it's a similar look. Yep, cutting below VWAP, getting towards the point of control. You can see that in that higher beta index. And then the Russell cutting below VWAP. Point of control was dragged up earlier, but also having that bearish look. Let's check in on crude. Crude managed to get above 78, but still technicals on this one look pretty bad overall. We could have some further selling to the 77 and change level. And then we have
S&P
gold
500
rebalancing.
turns negative, lost down 0.13%.
Oof. Oof level 12 out of 10 on that. And we also see the 10-year note getting some gravity, getting pulled lower here into the close. The euro, similar look, kind of rebalancing on VWAP here, giving back some of those earlier gains versus the dollar as liquidity comes back into that market. So overall, it's an interesting day. To me, I think the market's looking at this and saying, okay, we learned that the Fed is still hawkish in terms of they're not telling us when necessarily they're going to cut. They're doing this taper of QT, which, may help to ease some of the pressure and volatility in treasury markets, but it doesn't necessarily tell us really anything about what the overall policy impact is going to be here. QT kind of went off without too much stress in the system. So I think what they're doing now with the treasury market becoming less liquid overall, is they're trying to take some of the pressure off that market. I don't think they're running a victory lap tapering QT. I think it almost gives them cause to keep policy higher for longer. And there might be some folks in the market that are thinking similarly about that. And that may be why we're seeing rates pushing back higher from their lows. We're seeing equities revisiting lower levels that we saw earlier today. I don't think that's a coincidence, but obviously with Fednesday, you've got to give it some time to settle out. The initial reaction is often a little bit misleading. I don't think today was any exception in that regard. And I think that's the most important thing for us all to think about as traders and as investors, right? Don't get too complacent with the type of price action we see, particularly when it's happening amid a very illiquid market environment. You could see the way things were trading, during the Fed. Let's zoom out. Look at how liquid that market was before the Fed. And now after, it's still not liquid. Okay? So that's the other thing, is like this didn't get back to a normal level of liquidity. A bunch of people stepped back and still haven't come back in. Order book depth 49,000 right now, still pretty low across the order book. And we're getting right back to that warm put point of control level I talked about we get to if we slip below VWAP. That's not a small slip there, right? That's a slip of about 20 handles that we're seeing. So this is a market that is still trading in a pretty technical way. The flows really are helping to decide the direction here. And if we slip below this point of control, we could pretty quickly get down to this most active put strike, which is about 5,000 on S&P cash. So, the fun might not be over yet if this last 5 minutes is anything like yesterday. So, just be cautious here with trading, how much size you have, your placement of stops, your selection of trades. This is not a very forgiving market environment. You could think like, that this trend was going to keep going and have it completely reverse on you. Just like earlier, you could have tried to fade the Fed and look for a short and look for the move that's happening now and instead get your face ripped off. So it's a day to be careful. Seriously. I mean, look at that. That's like an 80-point move from there, or pretty darn close. So we got from 51.25 to 50.52. So still about like a 73-point, 74-point move. It's a lot that's happening underneath the surface in a very short amount of time. The market's just sort of flipping and flopping all over the map.
Ticker, APTV.
And I expect that we'll have some continuation of that type of dynamic into tomorrow, simply because we get a decent amount of economic data. We also have Apple earnings on deck. And then Friday, we have non-farm payrolls and other labor market data that'll be pretty important. That data print has been one of the most important to watch. And we know it always gets revised, but it doesn't matter. The market still reacts one way or the other. And if it's stronger than expected, rates up, risk off. It's weaker than expected, rates down, risk on. And it's sort of bad news is good news market environment. So I hope everyone out there has had a good trading day. I hope this was helpful to your trading overall. I would be pretty careful in this environment here, trading size. I really favor on weeks like this, smaller position sizes, wider stops, and much more selective entry and exit, because otherwise you can just get chopped up. I've heard people call this the popcorn maker, right? Because you get people's accounts getting popped left and right if they're taking too much size and getting wrong weighed by the market. It's also very much a two-way market, right? If you timed it right, you could have been doing well as a bull and a bear today, but how many people were able to execute that well? So be careful with the market environment like this is the key point. We've just got about 2 minutes left in the trading day. After the close, there's going to be earnings from Qualcomm, Devon Energy, Paycom, Fastly, Etsy. I'll keep things going for a little bit, and I'll put on the squawk so y'all can hear that. All right, so we'll have the Benzinga Pro chat.
1
there's
minute
Squawk
to the
on.
U.S. market close. Coming up right after the close, earnings from Qualcomm, QCOM.
And we'll have that out there so you all can hear some of the earnings as they're breaking after the market close, because I think that's helpful. We're still in peak earnings season. There's so many moving parts. So even though the main trading day is drawing to a close, the after hours session and all these earnings is just about to start. So we'll keep that going for a little bit along with the stream on my end here to help
Block
you all
trade
out.
and ticker, CZR.
But I hope everyone had a great trading day. I hope that even if you didn't trade, you walked away learning something. I think it was a very interesting day overall. Seeing these gains reversed is not terribly surprising. The trading as we got into those higher levels was very low conviction, low volume, low liquidity trading. And now we're finally starting to see the liquidity come back. Can you see it there? That heat in Bookmap?
Block trade and ticker, NE.
We're just balancing right there around that warm put, dragging the point of control just a bit lower as we're in the last seconds of the trading day. This
QCOM,
Fednesday.
Qualcomm reporting $2.44, beats the $2.32 estimate. Sales of $9.4 billion, beat the $9.34 billion estimate. Qualcomm sees Q3 2024 revenue of $8.8 billion to $9.6 billion versus the $9.05 billion estimate. Sees adjusted earnings of $2.15 to $2.35 versus the $2.17 estimate. Qualcomm increased quarterly cash dividend to $3.40 annualized payout per share. That's Quebec Charlie Oscar Michael. Qualcomm shares spiking here now, $170 at the high, or QCOM. Quebec Charlie Oscar Michael. CTSH, Cognizant Technology Solutions, $1.12. The estimate was $1.11. That's a penny beat for CTSH. Charlie Tango Sandy Hotel. Revenue of $4.76 billion. The estimate was $4.72 billion. So that's a beat for CTSH. Charlie Tango Sandy Hotel. PTC reporting $1.46. The estimate was $1.23. That's a beat. Papa Tango Charlie, revenue $603 million.
Block trade and ticker, CZR.
The estimate was $576 million. That's a beat for Papa Tango Charlie. FSLR First Solar, $2.20. The estimate was $1.99 for Foxtrot Sandy Lima Romeo. Sales of $794 million is a beat. The estimate $702 million for FSLR.
Qualcomm bid up 4.71% after hours here. Earnings well received.
UPWK, Upwork reported 13 cents. The estimate was 19 cents. Revenue of 190.9 million. The estimate was 186 million, so that's a beat on revenue for UPWK.
That was one of those pandemic era
SFM,
stocks.
Sprouts Farmers Market, $1.12.
So let's take a look at Qualcomm after hours here, since we can just pop that in and then backfill the day's data. So I'll pull it back. Let's just say 12 hours. Why not, right?
The estimate was $1 for Sprouts Farmers Market, Sandy Foxtrot Michael.
And I'll clean this chart up just a little bit as it kind of goes through and backfills all this data for us.
MPWR, Monolithic Power, MPWR, $2.81. The estimate on MPWR was $2.66. That's a beat. Revenue $457 million is a beat for MPWR.
So here's Qualcomm for you in the after hours session, getting a healthy little pop there. Closing around 164, currently bid 171.50, up 4.5%.
eBay expecting $1.20. eBay reported $1.25.
Block trade and ticker.
The estimate was
BAM.
$1.20
Block
for
trade and
eBay.
ticker. SU.
Revenue $2.6 billion for eBay. The estimate was $2.53 billion for Echo Bravo Alpha Yankee. Etsy, ETSY. Etsy reported 48 cents. The estimate for Etsy was 50 cents, so that's short. Revenue $646 million for Etsy is in line with estimate. Echo Tango Sandy Yankee.
Wow, that Etsy news is not being received well. The stock is now down 12.5%
AFL,
after hours.
Aflac reported $1.74. The estimate on Aflac was $1.58. That's a
Block
beat.
trade and ticker.
Revenue $5.4
APTV.
billion is a beat for Aflac, AFL.
DoorDash down 6% after hours.
CHRW, CH Robinson reported 86 cents. The estimate 62 cents. Revenue $4.4 billion. The estimate $4.27 billion for CHRW. CAR, Avis Budget, reported a loss of $3.21. That's wider than the $2.70 loss that was expected. Sales of $2.60 billion beats the $2.41 billion.
Block trade and ticker.
Estimate.
PINS.
That's probably Alfa Romeo.
So pretty violent reaction there in Etsy. Etsy is one of those stocks that I think has a very troubled business model.
Block
Etsy.
trade and ticker. APTV.
DoorDash down 10.5% after hours. Missing earnings. Soft guidance. Not looking great.
FORM, Form Factor, reporting 18 cents. The estimate on Form Factor was 19 cents. Revenue of $168.7 million is a beat on revenue.
eBay down
Earnings coming in a penny
2.5%
short for FORM.
as well. So multiple different companies having a pretty negative reaction after hours here. I would just be a little bit cautious here of any kind of after hours dip buying stuff, especially in some of these single
FARO, Faro
stocks.
Technologies, reporting 9 cents.
A lot of these single stocks like Starbucks, they were down like 8,
The
10%
estimate
last
was
night. It
a
went down
loss
more.
of 12 cents.
It went down
Sales
more
of
today.
84.2 million is a beat for FARO.
So Starbucks was down 16%
Yes, stop
today.
alert. Sell 1008.
DASH DoorDash reported a loss of 6 cents. The estimate on DoorDash
Trade QCOM at DX feed by price 169.7. Size
was a
2294.0.
loss of 4 cents, so that's a wider loss than expected. Revenue 2.51 billion is ahead of the 2.45 billion estimate for DASH.
Block trade and ticker, CZR.
Shares of Qualcomm off the highs now 169.82, up $5.79 after their better than expected report and dividend increase. That's QCOM. DVN, Devon Energy, reporting waiting for those numbers from Devon.
Yes, stop alert. Sell 1000.
GIL, Gildan reported 59 cents. The estimate was 51 cents for Gulf India Lima.
Yes, stop alert. Sell 1002.
Still seeing a little bit of selling pressure here after hours with those icebergs in the S&P. That's kind of
Sales of
interesting.
695.8 million. The estimate 693 million for Gulf India Lima GIL. QCOM and ARM, Qualcomm said on April 18th, filed separate complaint against ARM in U.S. District Court for Delaware that ARM has breached Qualcomm by failing to provide some deliverables that ARM is obligated to provide. That's QCOM and ARM. A FRSH, Freshworks, reported reported 10 cents. The estimate on Freshworks was 8 cents, so that's a beat. The company's CEO will transition to the role of executive chairman later today. That's FRSH.
Block trade and ticker, LYFT.
BODI exclusive to Benzinga. The Beachbody company tells Benzinga and that the company and telehealth provider Dr. B partnered to enable pre-tax reimbursements for Beachbody fitness solutions in all 50 states. Beachbody tells Benzinga, Bodhi, and Dr. B to help qualifying patients save time and money on fitness solutions by utilizing pre-tax health savings account or flex savings account funds. That's Bravo Oscar Delta India. CVNA, Carvana reported 23 cents. The estimate on Carvana was a loss of 77 cents, revenue 3.061 billion. The estimate 2.65 billion, so that's a beat for Carvana. Shares of Carvana popping here, $120.
Trade QCOM at DX feed by price 169.19, size 2100.0. Yes, stop alert. Sell 1005. Trade QCOM at DX feed sell price 170, size 4100.0. Trade QCOM at DX feed by price 170.45, size 4300.0. Trade QCOM at DX feed sell price 170.5, size 3603.0. Trade QCOM at DX feed by price 171.5, size 2523.0.
All right, folks, that's going to wrap it up. That's most of the earnings releases that we were anticipating. And we've seen the market reaction in some of these stocks after hours. Qualcomm still bid up 3.81%. So I'm going to call it a day. I hope you all had a great day. I'll be back tomorrow, and we'll be back talking about what's going on around the world in the markets and beyond. So stay tuned for that, and then also Apple earnings tomorrow evening. Until then, have a great night.